Good morning, everyone. Welcome to the June 17th IMSARA Investment Committee meeting. Couldn't call the roll.
Trustee Cooper,
Here.
Trustee Helway,
Here.
Trustee Martinovich,
Here.
Trustee Poole,
Here.
Trustee Robbie is absent, Trustee Silverstein,
Here.
Trustee Vasquez,
Here.
Trustee Vila,
Here.
Trustee Werby,
Here.
Trustee Healy is absent, Trustee Jones is absent, Trustee Shaw. So Chair, all members of the committee are present except for Trustees Robbie, Healy, and Jones.
And I understand no requests for teleconference.
There are no teleconference requests today.
An open time for public expression. Okay, we have a busy day today. We're going to hear from 6 different vendors talking about private credit. Interviewing them until about 1300, and then we'll move on to a wrap-up discussion. So without delay, I'll hand this over to Jim Callahan and set the table.
Okay, thank you, Chris. Good morning, everyone. Yeah, long day here. Finally getting to the point where we're gonna interview managers for assignments for your 5% allocation to private credit. We've categorized them in 3 different buckets, if you will. The first category you're gonna hear from are lower middle market direct corporate lending strategies. Then you're gonna hear from middle market direct lending strategies, and then finally from asset-backed finance strategies. Just a reminder, the board has decided to split the 5% allocation 60% to corporate lending, split between lower middle market and middle market, and then 40% to asset-backed finance. Not a lot of time to get into the weeds. 30 minutes is pretty short time to interview managers. Just a reminder, each of these firms has gone through a pretty rigorous due diligence process at Callen. So that's why they're in front of you today. We think that they're all very capable of the assignment that you're looking at today. I think, the things to focus on are the organizations, the capabilities, and how they articulate that they are differentiated in the space that they're being considered. Our colleague Kaz is, I think, on Zoom.
I am.
All right. Hey, Kaz. There it is. Hey, Kaz, anything to add before we kick off here?
Yeah, hey everyone. Apologies I can't be with you in person, but great to see you all. I'll be brief because I know you've heard a lot from myself and our side, but wanted to just give really quick preamble to kick off sort of each vertical. I'll just touch on lower middle market right now, but we continue to favor lower middle market. Notice that lenders can earn a premium over core middle market, but note that these are more customized financing solutions to smaller businesses, often overlooked by some of the larger lenders. So these companies are typically founder-owned or backed by smaller private equity sponsors. So that results in less competition, higher spreads, stronger documentation, and lower leverage compared to some of the upper middle market direct lending transactions. And so thinking about, we'll start with Twinbrook, who you'll hear from first, but this is one of the largest dedicated lower middle market lenders, very deep sponsor relationships, significant scale, and they have extensive experience in navigating the lower middle market, especially with respect to workouts and restructurings. And then we'll talk about Fidelity. Fidelity combines really large institutional platform with what we found to be a very conservative underwriting culture. Do note some technology exposure, and that's very, much so in light, just of course, because of recent software valuations and how that's been pressured in recent years. But comfortable with management, avoiding, underwriting to more aggressive ARR assumptions. But I'll stop there because I know we want to hear from the managers.
All right. Thank you, Kaz. Okay, well, this time let's welcome Drew Guyette and Victoria Choi from TPG Twin Brook Direct Lending Evergreen Fund.
That tall. Good morning, Chair Cooper and members of the Marin County Employees Retirement Association Investment Committee. Thank you so much for your time today. My name is Victoria Choi. We sincerely appreciate the opportunity to present the TPG Twin Brook Direct Lending Evergreen Fund for your consideration. I'm a principal on TPG's Client and Capital.
1 second. Jeff.
You're welcome. Just
I
move
hear
it.
Oh, okay. We know you. Okay,
There you
okay,
go.
sorry.
Is that better?
Better?
Better yet.
Better?
Yes.
Okay. All right.
Move it.
Not very tall, sorry. Okay, so again, my name is Victoria Choi, and I'm a principal on TPG's Client and Capital Formation team based in our LA office. I'm joined by my colleague, Drew Guyette, Co-Chief Credit Officer and Senior Partner of TPG Twin Brook. By way of background, TPG is a global alternative investment firm with over $300 billion in assets under management across private equity, credit, real estate, and market solutions. Over the past 3 decades, we have built one of the most diversified alternative investment platforms, and with the integration of Angelo Gordon in 2023, it established our credit capabilities and expanded our ability to serve institutional clients with differentiated risk-adjusted returns across the credit spectrum. Within TPG Credit, we manage over $90 billion in assets across 4 core areas: lower middle market direct lending, Twin Brook, asset-based finance, credit solutions, and global CLOs. As a testament to the strength of the TPG platform and the trust our clients have placed in us, we manage close to $50 billion in active commitments on behalf of 115 U.S. public pensions, including 20 California-based plans. We deeply value the partnerships we have built with our clients who entrust us with managing assets on behalf of members and beneficiaries dedicated to public service. We're incredibly excited to share more details on TPG Twin Brook, and we appreciate the opportunity to potentially partner with the Marin County Employees Retirement Association. With that, I'll now turn it over to Drew to provide an overview of the Twin Brook strategy and our long-tenured and senior team, discuss the disciplined investment approach that has consistently delivered for our clients since 2014, and highlight the key structural features that differentiate TPG Twin Brook in today's competitive direct lending market. Thank you.
All right. How was my audio? Doing okay?
Thank you.
All right. Fair enough. I also don't know where to put my hands on this podium, so I'm going to try my best not to look awkward. Good morning. Thank you again for giving us the opportunity to talk and spend a little more time talking about Twin Brook. As Kaz and Victoria mentioned, we are a lower middle market direct lender. We were founded in 2014 under the umbrella of Angelo Gordon. 2023, TPG acquired Angelo Gordon, but I think at the roots of what we do, lower middle market lending, we're one of the few dedicated direct lower middle market lenders for 20 years. And I think that's important to define the why behind that. Most groups in direct lending have a tendency of either raising a larger fund and continuing to raise larger funds and move up market. Our natural competitive landscape over the past 25 years has shown us this. Twin Brook is the only group that has consistently stayed dedicated to the lower middle market. Your other alternative is to become a new organization. And the easiest way that you can access capital and deploy that capital is by targeting the larger part of the market because it is more transactional in nature, more commoditized. We feel like the lower middle market is the remaining piece whereby relationship still matters. As Kaz alluded to in his opening comments, you're able to still take advantage of a dislocation or a fragmented marketplace. You're able to structure better credit protections. You're able to take a more thorough 90-day underwriting process and bring that type of lending expertise. So TPG Twin Brook is unique in that we're one of the very few groups that for 25 years has been judiciously disciplined to the lower middle market. And we think that that characteristic wrapper allows us to create the least volatile experience for our LPs. So on this page, you're going to see a number of different hallmarks associated with our strategy. Let's just tick through them really, really quick without reading the page. We are 100% a senior lender. We don't do second lien. We don't do mezz. We don't do equity-like instruments that juice up the return. And that's further backed by we are the revolving line of credit to these companies. That is a structural nuance in terms of how we lend money to the companies, but it's an important one because that revolving line of credit allows me to have a daily and a weekly insight into how these borrowers are performing. Think about payroll cycles. You think about working capital. You think about the impact of tariffs or the pandemic. Having 100% revolvers allows me that lens into those borrowers. So it's both a structural advantage, but also a portfolio management tool. 100% of our transactions have financial performance covenants, and almost 100% of the time we are the administrative agent to these borrowers. That titling, that definitional characteristic means that we are interacting with the private equity firm. We are interacting directly with the borrowers, thinking about the underwriting process for 90 days, thinking about the monthly financial statements, the revolvers. We're in the driver's seat of how do we structure the credit agreement, the collateral package, as well as the financial covenants. When you are not 100% of the time the administrative agent, you're just simply buying the market. You're going to a group like Twin Brook and saying, do you have excess debt that you could sell to us? So we're creating alpha, hopefully, in this marketplace. The last piece that I want to point out here, which is an important one, we're going to take the inverse of 100%. 0% of our loans are issued with PIK on day one. We are a senior lender lending to lower middle market businesses that have a historical demonstrated financial performance. These businesses generate cash flow and have already demonstrated a history of doing so. We don't believe that as a senior lender, you're supposed to issue debt that is containing PIK. And that also ties into the fact when you look at our end market exposure, we don't have much by the way of technology and software exposure because we won't lend on revenue. And we also don't have PIK associated with our loans, which is a corollary to much of the technology and the software exposure. The left-hand column, and I'll close on this page with, you can see the size and scale. We are the market leader. We do have the largest market share by measure of the lower middle market, and we define that as 25 million of EBITDA and below. We do think market leadership and scale matters on a number of different fronts, but as a chief credit officer, I'm going to highlight a few. We see more transactions than anyone else in the marketplace. Therefore, we can be more selective on the underwriting side. Evaluate over 1,000 to 2,000 unique opportunities every year to only close on the best 50 to 75 unique transactions. 2, create a highly diversified portfolio experience for our LPs. Less than 1% borrower sizes in every vehicle that we bring to market, creating the highest amount of diversification inside of the portfolio. I also think it speaks to our scale too. We are one of the largest platforms in Chicagoland. So we have just inside 140 dedicated professionals to the strategy. And then as Victoria's already mentioned, TPG is a global parent company. We're able to tap almost inside 400 unique individuals to support our strategy remotely. So let me just flip through a couple more pages here. We don't have to spend a lot of time here on the org chart, but I do think this stands as a differentiator and speaks to the infrastructure we've been able to build in this strategy. You can see on this page, I'm supported by my co-chief credit officer, Kim Trick. And there are a number of co-heads to every single department, taking away any sort of key person risk to the strategy, as well as speaking to the benefits of our market share, providing more infrastructure. I'll do a couple other call outs here. We have a dedicated workouts team. Most direct lenders do not have a dedicated workout team, so that serves as also a differentiator. You will not get it right 100% of the time. And when it breaks, are you in a position to react? Are you proactive or simply reactive? Are you able to have an owned assets approach? Look at these businesses, reconfirm why you underwrote them and their value proposition, and then step in to help bring them back on the path of righteousness. But I also call out our capital markets group. With our size and infrastructure, private equity firms pick us because you don't have to refinance us out. And as you grow these credits, we're able to size with you. And that's supplemented by our capital markets function. The last note on this page, originations. We take a slightly different approach than most groups. Our originators are born from credit and underwriting. So if you go through their resume, you'll notice that all of these individuals are homegrown. So they came up through our legacy company as well as through the credit and underwriting side of Angelo Gordon. So that serves as a slight differentiator. We don't hire new business people that just go and bird dog opportunities. These individuals on the front line serve as underwriters and credit people as well. One nuance to this page that I would also like to call out as a differentiator to our strategy. You will notice the number 1 as a footnote behind the years of experience. While we are a time-tested strategy alone in our track record at TPG Twin Brook, that number 1 also designates that the majority of your senior team, your investment committee members, your senior members of different departments came from Madison Capital Funding, New York Life Insurance. This senior team has been working together for the better part of 15 to 20 years. During our time at New York Life, we ran a very similar strategy to this with the same characteristics and the same go-to-market approach. I think that makes us unique. I think you will struggle to find a group that has, in a collaborative setting, done this exact same strategy and also been time tested through the GFC, the pandemic, high interest rate periods of time and low interest rate periods of time. So that also hopefully serves as a complement to the strategy. The last place I would like to go is to talk a little bit more about why the lower middle market, and then maybe close on industries and exposure and really what are these types of businesses that we're lending to. As you can see here on the chart, we do feel like in addition to the credit characteristics and qualities we are able to obtain in our underwriting process, there is an economic premium associated with the lower middle market. As you see here, defined by 20 million of EBITDA and below on the bottom left-hand side. When we look at spread per turn of leverage, and I want to really unpack what that means, is for every unit of risk, how much are you receiving on a risk-adjusted basis for the economics? That blue line, the top line, represents the lower middle market, consistently punching above the middle market in the core part of the market. These are invisible lines that exist in terms of when that spread per unit of risk disappears, but there is a consistency that we have observed for 20 years, and that's why we continue to keep reinvesting and doubling down in the lower middle market in terms of our go-to-market strategy. And markets and industry exposure. We are a US-based business. We target US-based borrowers. Periodically, you will have small subsidiaries with foreign jurisdiction, but we want to be measured by the court of law in terms of Delaware, New York, Illinois, and Texas. There are a number of different complexities that are presented when you start to deviate and create those asymmetric pieces of exposure inside of your portfolio. What stands out on this page is healthcare. It's approximately 34% of our exposure. If you were to look at US GDP, healthcare is around 22% of US GDP. But draw your attention to the avoided industries. If we took US GDP and we subtracted the avoided industries, I think we'd be appropriately indexed to healthcare under that formula. When you look at avoided industries here, our philosophy for 20 plus years has been take away the most cyclical as well as the most volatile industries and don't lend to them. Last point on that. Also, where required, be specialized. If you are going to take a concentration, if you are going to invest, be specialized in that part of the market. And so I point out for that oil and gas and energy. We don't lend to it. We do believe you have to be specialized to lend in that part of the market. We have no negative bias towards that industry in general, but there are tremendous kind of small details that will aggregate up from a senior debt and a credit lens. When I observe healthcare, and what I didn't point out on our org chart, 1/3 of my staff is dedicated to healthcare. Day in and day out, that's all they do. We have a dedicated healthcare team that starts with originations, as well as team leaders on the underwriting side, as well as 1/3 of my underwriting staff. So where we do have that concentration, we believe we have appropriately backed it up with the human capital to support it, as well as the tacit knowledge required to support it. Lastly, you'll see on the right-hand side, we're incredibly diversified in healthcare. We're staying away from the very volatile sectors, in our opinion, the heavy bio and the pharma and the healthcare tech side of the world. Most of what we do is what I would describe as more retail-oriented healthcare. We're looking for those routine maintenance types opportunities. We are lending to your dentists and your dermatologists and your vision. We are lending to the outsourced business services that support hospitals and medical centers with their revenue cycle and reimbursement collections. We're doing a variety of education, research, analytics in terms of what we do for healthcare. But we're not taking those kind of more volatile exposures on the healthcare side, more of the venture capital nature healthcare investing. We think in the lower middle market, that's not the right place to invest as a senior lender. Bottom right-hand side, you do see we have certain considerations around UN CI compacts and principles, carbon emission, Article 8, Article 9 funds. So it is something that is top of mind and present. We do view this to be at the core of credit risk. So very easy in terms of when we look at the last 20 years of how we've approached this market and what we've been able to build, slots in very nicely in terms of responsible investing. I'll try to be cognizant of time. I know you guys have a long day. I think I heard in the opening comments. So when I look at this page and try to summarize the dashboard of what we've been able to accomplish and what we've been able to build here, it's certainly something we're very proud in. The 10 plus year track record at TPG Twin Brook, we've been able to establish a firm of size and scale and over $32 billion of AUM dedicated to the lower middle market. Maybe it's my Chicago nature, but I generally describe our strategy as vanilla ice cream. We're a senior lender. It's supposed to be pretty straightforward with a pretty tight credit strike zone in terms of how we approach the market. That's generally how we will discuss investment committee, and we'll think about evaluating these opportunities. We didn't spend a lot of time on portfolio management. I think these conversations naturally lend themselves to how do you invest in a strategy? How do you deploy capital? But the reality is the infrastructure and the size of our team and that collaborative nature I described is tremendously important to portfolio management. How often are you interacting with these borrowers? The differentiator of the lower middle market and the upper middle and the core is that we are talking to our borrowers daily and weekly. As you move up market, that financial reporting frequency slows down. It widens out. You get financial statements every quarter. You may not know, you'll have blind spots in terms of what is happening inside of each quarter. When COVID was upon us and shelter-in-place orders came into play, it took us approximately 5 business days to bring down the entire portfolio and map who had shelter-in-place orders, who had deemed essential, who was impacted by the pandemic, work from home, work remotely. That's different. That's unique to the lower middle market and how we have targeted these borrowers and built the portfolio management function for it. So let me pause there for a second. Any questions?
Go ahead.
I have 2 questions. One,
Yes.
You were acquired by TPG.
Yeah.
Can you give us some of the rationale behind that and whether any future changes might in ownership or management might come about? And second, healthcare is heavily subsidized by the government,
Yes, sir.
and there's a lot of political uncertainty about whether that subsidies will continue and how will that affect these loans to the healthcare industry.
Sure. I'll take your first question first. Thank you for those. When you regard this page, I want to draw your attention to the 4th vertical column, credit. Really what TPG acquired was a credit strategy from Angelo Gordon. No disrespect to the real estate exposure we had at Angelo Gordon, but 3 primary pillars of credit, which was absent at TPG. TPG historically has a reputation and a brand of being equity oriented as well as real estate oriented. So I think the attraction of acquiring Angelo Gordon was those credit verticals. When I think about the impact of the acquisition now being 2.5 years by ownership, as well as 3.5 years if you include the diligence period, the courtship of the relationship, we've had a lot of time now to interact with our new parent company, understanding their culture, integrating the best we can. There were a number of upgrades that we, by extension, received with TPG as our parent company. TPG is a publicly traded company, which means when you think about compliance and SOX reporting and all of the infrastructure, you just got a shot of steroids in terms of what Angelo Gordon was. Angelo Gordon was a market leader and a global alts asset manager, but TPG kind of dialed the notch up to 11. When I think about changes in management, absolutely nobody has changed from an investment committee perspective. We've had no key person departures at TPG Twin Brook. The strategy has been the same for the last 2.5 years. We have retention tools in place to ensure that senior leadership continues on with the firm into future periods, as well as alignments, both economically and in other ways. So for all intents and purposes, it has worked out very well for the TPG Twin Brook team. And we continue to operate, as you regarded on that org chart, really as a large boutique strategy in Chicago supported by a global parent company. Does that answer your question?
That's good.
And then, sorry, would you like me to hit healthcare real quick?
Yeah.
Please, please. Just to round out that question. As part of your underwriting for any healthcare transaction, reimbursement risk and the mix of reimbursement is tremendously important. Now, when you look at the right-hand side of this page, what hopefully will jump off or you'll be able to see on the second level or third level is most of the businesses we target are commercial payers. We are not looking to engage in heavy stroke of the pen risk associated with Medicare or single state Medicaid. To some degree, that is unavoidable. You will have 10 to 20% of that exposure inside of your overall revenue. But the vast majority of what we target on the efficacy side of practitioners is associated with commercial pay. And I bring dental as an example of that, or vision. Most of us are seeking commercial reimbursement on the insurance level for that. So it's not a perfect answer, but in terms of 80% getting there on the answer, that's generally how you look at it. Now, on the Medicaid level, you do have to walk state by state by state, look at the funding, look at the deficits, engage third-party proprietary research around the payer mix associated with that state, and kind of really spend that 90 days of underwriting to truly understand if this is a business inside of that state you want to work with. Does that make sense?
Yes, thank you.
My question relates to deal sourcing and
Yes,
deal
sir.
flow. TPG has a long storied and outstanding history in private equity. And here you mentioned that, in your vertical, if you will, the middle market direct lending for your credit strategy, you source a lot of deals from private equity sponsored companies or assets. How much overlap is that? Are those deals coming in from the private equity side of TPG, or is that deal flow and that pipeline coming from your proprietary, you mentioned your investment team, your professional team, their relationships? So, and to what extent and what's the percentage of your deal flow that is private equity sponsored?
Sure.
Whether TPG or non-private equity.
I'll try to take them in reverse. And if I forget,
Fair enough.
please remind me. 100% of our transactions are private equity backed.
Okay.
When I think about the small bias, the negative bias associated with smaller companies, generally we'll think about two concepts. We will think about weaker or lesser management teams, governance of these companies, resources. And the second one we'll think about is capital, balance sheet, wherewithal. So do these smaller businesses have a reason to exist? We believe that the private equity wrapper, that ownership, provides and mitigates both of those risks. Private equity firms bring strategic senior operating partners at the board level. They bring their own resources, their expertise to supplement these borrowers that they are acquiring. And then two, private equity firms have committed funds with capital not only to close it on day one, but to support this business through its growth or underperformance period. So 100% of our transactions have to be private equity owned. We will not lend to a non-sponsored direct to borrower private business because we do think that that small bias risk is real. The other way you can take and mitigate that small bias risk, look at a lot of transactions, 1,000 transactions to 2,000 transactions every year. I've gone to this page to demonstrate this isn't something new. When you look at the very beginning, and this is just the TPG Twin Brook track record, you can see consistently every year 1,000 new transactions dating back to really when we opened our doors in 2015. When you think about 2023, when TPG acquired us, we already had tremendous momentum in this archive and library of 10,000 unique observations that we had already reviewed. So the proliferation and the scale and the breadth at which my originations covers geography-wise, the US, already established. When I think about TPG specifically, we do not lend to the TPG Equity Group, and we will not lend to the TPG Equity Group. We have a massive compliance department and walls that sit so that we do not talk to each other. We could certainly dissect that and think about it on a brand level. How would our competing private equity clients think about us self-dealing to the private equity arm? We could certainly look at the sleeves of private equity that TPG currently operates in regard that they are at the upper part of the market. They are working with businesses that potentially could IPO. And so they're also in a different atmosphere than most of the private equity firms that we are currently working with. So without disrespecting our parent company, I would say TPG has not changed or helped our originations. I do think the overall TPG brand is very well respected amongst the private equity community. Angelo Gordon, our prior parent company, was, for all intents and purposes, on a brand level, known as Distressed Credit Opportunities. We intentionally chose the Twin Brook brand as to differentiate in the mindset of our clients. When you're talking to Twin Brook, that's who you're working with. Similarly with TPG, we'll continue on with that branding.
Thank you.
As I understand it, you offer both a closed and open-end fund option.
Yes, sir.
Can you describe to us the advantages and disadvantages between the two?
When I think about the growth of TPG Twin Brook, we started out with closed-end funds, onshore and offshore sleeves, thinking about our different LP base and both on a geography level as well as a tax level. As we have grown the AUM and continued to scale it to get it back to the same size of what our predecessor company was, we were able to meet our LPs and understand their needs and how they think about managing their capital and how they would like to invest in the thoughts of how their consultants were working with them. That is to say, closed-end funds, we were able to take on more SMAs, able to open up evergreens, thinking about other vehicle structures, but never changing how we think about our credit strike zone or the investment committee process. So every transaction that we look at has to work for every vehicle. And I think that lead-in is important because I don't believe there are truly advantages or disadvantages on the T columns of the closed-end funds or the evergreens. What we're really talking about now is duration. What we're talking about is also how often you want to re-up or thinking about your investment committee, your capital allocation planning over the course of the next 10 years. Through a tremendous amount of dialogue and in concert with the consulting community, we brought the Evergreen product to market because many of our clients are habitual re-uppers into our funds. So every 18 months to 2 years, they would have to bring an investment committee together and say, can we re-up for Fund 2? Can we re-up for Fund 4? Can we re-up for Fund 6? And for some, that got tiring, to say it quite simply. And so the Evergreen fund allows you to stay invested on a longer duration with the LP having a put option to say, we would like to go into slow pay harvest. So administratively, I suppose you could argue that there is an advantage. For many groups, they like the checkpoint. They say they want to check in every 2 years and re-underwrite the strategy on a new allocation. A closed-end fund will have a camel's hump. We will draw it all up, it'll reach the height, and then it will start to go into harvest mode. And so you could almost think about sine curves for us calculus nerds that kind of think about layering those humps and thinking about capital allocation, how much is committed, how much is drawn. The Evergreen is a little bit more like an airplane, gets up to cruising altitude, and the AUM stays out there until you say it's time to land. But from a returns perspective, I think you would find that the returns of the Evergreen fund and the levered closed end funds, they practically mirror each other.
You would have no bias between you. Obviously, we'll have someone give us a recommendation about how to do this, but from your perspective, there's no advantage to going one way or the other.
Depending on who you are as the LP, if you are a high net worth individual, I might tell you that our public but non-traded BDC might be a better individual from a tax reporting perspective, fewer K1s, 1099 tax basis. If you were a corporate or a pension and you were thinking about making investments into a fixed income allocation and you didn't have anything, and so you were putting permanency in there, if this was discretionary overflow, I might have different answers for you as I better understand the LP. But in terms of the outcome, taking time off of the table, no, I don't think there is a difference.
So in addition to what Jim said at the beginning, which is that your decision point had been a 5% target, a 60-40 split between direct lending and asset-based and evergreen funds. That was the decision you made at the investment committee.
When you say and evergreen funds, I
That,
didn't
that
understand that.
it would be evergreen fund features, not closed-end features.
The managers are presenting evergreen.
Evergreen
today.
funds
That
to-
Decision's been made by the
Oh,
board
we're
already.
going with evergreen.
Yes.
That was the decision that was made at the investment committee when you decided to make the allocation decision. So that was part of 5%, 60/40, and we're going to use evergreen funds.
Thank you for.
All right. Well, show us at 9:35 and Drew, thanks for your time. Thanks for the presentation.
Thank you for having us here. Enjoy the rest of your day.
It's
Ashley out of town? Is Ashley
Oh,
out?
he's at a pension conference.
Chicago.
No, not that one. In Michigan, Napa.
Okay. You just said, tell.
Yeah.
Congratulations.
Oh, thank
Well done.
you. Thank you.
Must have been beautiful.
Let's wait just a moment, Art, for Jeff and Jim to get back. Okay. All right, let's welcome in our second presenters today. We have Art Greenwood and Therese Ikas from Fidelity Direct Lending. Talk a little bit more about the lower middle market. Welcome.
Thank you. Well, good morning. On behalf of Fidelity, I'd like to thank the committee for inviting us to present today. This is a terrific opportunity. I'd also like to thank you for our 4+ year emerging market equity relationship that we enjoy with the fund. Thank you very much. By way of brief introduction, my name is Art Greenwood. I'm responsible for relationship management and client service for our public pension clients here on the West Coast. I'm joined today by my colleague, Therese Ikas. Therese is the managing director and a founding member of our direct lending team. She co-manages all of our direct lending funds and oversees the entire investment process. Prior to joining Fidelity, Therese was the co-head of credit and underwriting at Twin Brook Capital Partners. Over the next 15 to 20 minutes, Therese will highlight how we have combined an almost 50-year history in leverage credit at Fidelity, a world-class research team, and a global trusted brand to create a truly differentiated experience for our direct lending investors. We look forward to your questions and thank you for your time, and I'll yield to Therese.
Good morning. Thank you so much. Really excited to be here and appreciate your time. Before I jump into our direct lending capabilities, I'd like to spend just a moment to give you a little bit of background about why I'm so proud to represent this firm. Fidelity is a very unique place, and the culture is really rooted in putting our clients first in everything we do. And what that means is we don't enter a new arena, a new strategy, offer a new fund for the sake of doing it. We are doing it because we believe that our clients are looking for that and that it's in their best interest that we are able to offer a Fidelity quality experience for them and whatever that strategy might be. That culture drives complete alignment with you and your beneficiaries. Every decision we make, including the decision to build the direct lending business versus buy it, is really rooted in that foundation. Another important point to note is we are a private company. We do not answer to public market pressures. We do not have quarterly public company filings. We do not answer to stock price. We answer to you, our investors. Incentives really matter in this business. That allows us to have a very long-term horizon, aligning again with your long-term horizon that you have the responsibility for your beneficiaries. And so we believe that the way we've established and built the business over 80 years, and why I'm so proud of what we built, is we don't have AUM targets. We don't have sales goals. We are really focused on investing in the right companies in the middle market that allows us to generate attractive risk-adjusted returns for our investors over a very long-term period of time. Lastly, I'll just say this is very personal to me. I grew up in the city of Chicago, surrounded by public servants. My father-in-law worked at the 911 center. My sister-in-law is a Chicago public school teacher. I have city mechanics and electricians in my family. And so I know what the gravity of what we're being asked to do is, and take that very seriously, knowing that people in my family rely on their pension for their livelihood. With that, I'd like to talk about, who we are, how we invest, what makes us different, what the portfolio looks like that you would be buying into, and why we believe this approach fits the responsibility that you carry as fiduciaries. So flipping to the first slide, we built this direct lending business consistent with our credit heritage and discipline over nearly 50 years. There's very few firms that can say they've been at the forefront of leverage credit for nearly 50 years. Because we built Fidelity Direct Lending and not XYZ owned by Fidelity Direct Lending, we benefit from all of the infrastructure that protects your capital from risk, compliance, legal, tax, research, that we believe really is unparalleled. That is, signifying our behavior across our business. We don't take shortcuts. We could have, if we were focused on growing in AUM and fees, we could have bought someone and been much larger in this business, and that's not what we're here to achieve. Within the direct lending business that we built, we focus on lending on a first lien senior secured basis, which means we're first to be repaid in a distressed situation. And we lend to PE-backed businesses. Our median EBITDA is about 17 million, so we're starting squarely in the lower mid-market. We'll talk about the portfolio performance, as we move forward. I'll spend a minute on the team because I think this speaks to how we behave. We built the direct lending business person by person. Our investment committee leadership averages 25 years of direct lending experience. 90% of our senior team is bank credit trained. We think that's really important to have that DNA in good times and especially in bad. We are trained to focus on downside protection. What happens when things go wrong? What is our collateral? What covenants do we have to protect us? And what is the structure that's going to result in the best recovery, not on yield? We're not chasing yield. We've built a very diverse team by background, experience, thought, and we think that shows through in our results. Importantly, and this is a big part of our culture, we do not have salespeople or originators versus credit people. Everyone on our team is an investment professional focused on investing in the best quality companies and getting that capital back. And that culture, it's a nuance, but it's really important back to that incentive alignment with you. Nobody is compensated based on AUM or hitting a sales target. Going to the next page, this is our returns. We're very proud of the returns, but I ask you to focus on the drivers and not the headline numbers. That will tell you kind of how the returns are generated. When you look at the loan level snapshot, this is what our portfolio looks like today. Very conservative leverage, 4.4 times, 2.5 times interest coverage, 41% loan to value, which means the private equity sponsors have 60% cash equity beneath us in these structures. 40 million of TTM weighted average EBITDA relative to that 17 million I mentioned earlier means our companies are largely growing and performing. And as they continue to grow and diversify, that obviously de-risks our investment in those borrowers. Really important here that's not on the page, and I do believe is unique to us. As a part of Fidelity, we value transparency. And what I mean by that is we value every single one of our loans every single month by a third party, which means we're not grading our own test. So every single one of our loans is evaluated by Lincoln International on a monthly basis. That price that they assign based on the monthly financials that we get, the budgets, is driving those returns. And so the health of our portfolio is truly reflected in these returns, which, I think is a window into our culture. And not to say that, past performance is going to be indicative of future, but we're really pleased with how we've built this business and this portfolio. I'll spend a minute on this, and I won't go into mapping the market. Feel free to jump in with questions if you have them, but I won't go into mapping the market. What I will say is we chose deliberately to invest in the middle market with a focus on lower mid-market companies where we believe a void has been left by larger managers that have moved up market. And we're uniquely positioned with the scale and the infrastructure and the resources I spoke about to provide a scaled solution in the lower mid-market for our client base. When you look at the small green bubbles, our competitors that we might see when we're competing for individual investments, they are being acquired, they're being merged, they're consolidating to try to gain the necessary scale to provide that transparency, that compliance, that risk oversight that we inherently have being a part of Fidelity. So with our brand, we believe we've filled a void that is unparalleled. On slide 9, this is our philosophy, and what really lays out on the left is everything that we want to see in our investments. High access to management, lower leverage, material, real financial covenants, higher spreads, and we believe that this results in increased downside protection for our investors. On slide 10, this lays out our diligence process. What we really start with is trust but verify. We do not rely on anything that the private equity sponsor shares with us. We do all of our own independent industry work, which I'll get into in a little bit more detail. But that's really important. In 20 years of doing this, I think I've had one industry study I've received from a private equity sponsor that was negative about the type of business that they were looking to us for us to invest in. And so doing your own independent work, while of course leveraging the significant investment they make in their due diligence is important. But in my experience, credit mistakes almost always happen at origination. And so where we are able to use resources and research that I've never had access to in my career to allow us to avoid making those credit mistakes and remove blind spots is really, again, enhancing that downside protection. It's not a sponsor-first strategy. We underwrite the owner, but the sponsor themselves, even if we have an A+ sponsor, if they have a C- credit, that's not going to work for us. So it's important. Yes.
Along those lines, Teresa, can you talk about lender protections that that are built into these agreements, and also the percent of deals that are done with covenants?
Absolutely. So we are admin agent or joint lead arranger on nearly 100% of the investments that we've done. So 98% of the investments, which means we're driving the documentation. Not only are we focused on the presence of financial covenants, and not just the presence of them, but the levels at which they're set, the EBITDA definitions. So what goes into calculating that covenant is where our team spends a significant amount of time. That's one part of the equation. The other part that, is less talked about is all of the protections around those covenants, and that's related to collateral protections. What can the borrower do in terms of incurring additional debt? What can they sell without our permission? How can they take cash out of the business? And so generally what we're looking to do is ensure that specifically when we're starting the lower mid-market, we have those maintenance covenants that are set at a level well inside the enterprise value, such that we're back to the table before there's erosion in that value. And we'll get to an example of that in a bit. But also the collateral protections that really locks down what they can do in terms of our collateral, our cash that they're generating, and requiring that those any meaningful diversions from that, they have to come back to us to seek approval to do that. We have businesses that scale beyond the lower mid-market. And we think that that is good diversifying risk when we know a business, we know a management team, and they continue to grow, and we're able to retain strong protections. But a company goes from, which has happened in our portfolio, 25 million of EBITDA to 125 million of EBITDA. The 125 million of EBITDA company inherently has different credit metrics and different covenant and structural protections. The benefit of staying with us is that we keep those structural protections as they scale and grow. But when there are situations that are diversifying for us from an industry perspective with high quality companies, we will evaluate a springing covenant structure, which means if liquidity goes below a certain level, there will be a springing covenant on those deals. When we're starting in the lower mid-market, we're focused on meaningful maintenance covenants for those investments. Is that helpful? So all of our investments go through a 30 to 90-day process. There's no shortcuts. Everything is in the same consistent presentation, and our team is required to go through every step of this before we will close and fund an investment. This is perhaps, I'll spend a minute here. This might be the more underappreciated part of our value proposition. And as I mentioned, when you are blind to something that's happening in an industry that your lower mid-market company is operating in, that is where you can have real risk of loss. And where we are able to leverage the broader Fidelity research platform and infrastructure to remove those blind spots is extremely powerful. And it's not just the research that we have. So we have 496 research professionals covering 30 plus different sectors, 5,000 in-house visits of management teams per year. All of those things are published in a database that we have access to, but our team is treated just like any portfolio management team. So any question we have or looking for insights from our research analysts, our team is picking up the phone and talking to them. We're not relying on the industry study that the private equity sponsor is providing to us. I'll give you some examples of this and how this has allowed us to say no to investments that other people have done, and we believe avoid those missteps. We have one of the preeminent aerospace and defense analysts covering Boeing, Lockheed Martin, Northrop Grumman, all of the major OEMs. When we're looking at an aerospace and defense business in the lower mid-market, if I don't have the validation from that analyst that the platforms that our company is servicing are durable, that there's going to be continued demand for their products, it's very hard for me as a risk person to agree to finance that lower mid-market company in that particular sector. This analyst comes with us to meet with management teams. He's providing his insights and his sector expertise to management teams, which is extremely valuable to them as well. We are able to turn down deals that others might lean into. Software is a power alley for Fidelity. We're underweight software in our direct lending business, and part of that is because the structural elements, to your point, Chris, on covenants and other protections in that specific sector have gotten very aggressive, and so we've been underweight software in large part because of our discipline around structuring, but also because we're able to use our procurement team, which leverages 1,200 different software vendors, which means they've evaluated 10,000. Any software company we look at, someone within Fidelity has expertise to say, yes, that is a durable product, or no, we chose to use a different vendor, or we're developing our own in-house product and we're going to cancel that subscription, which is something that just happened to us on a deal we were able to pass on, where the private equity sponsor had glowing recommendations from the customers. And we were able to come to them with real insights and say, this is beyond the credit risk we're willing to accept. Put all that together, we have a true halo that allows us to bring all of our leverage credit experience, our direct lending team's experience, acquire talent, continue to build upon our underwriting resources, and we have a recognizable brand that management teams and private equity sponsors want in their capital structures. Management teams generally look very favorably upon a Fidelity term sheet. 1 in 4 U.S. families have a relationship with Fidelity, and they generally view it as a trusted brand. That allows us to increase deal opportunities that we review and then increase selectivity, which obviously benefits our investors. Our access to capital, this is critical. As one of the largest counterparties to major banks, we have a very efficient cost of capital, which benefits all of our investors. And so all of that combined with our risk management and profile, we think really provides our investors significant value and downside protection. This is a snapshot of the portfolio. This is laying out how we compare relative to the market on every relevant metric versus Lincoln International's over 4,000 loans that they evaluate. We are more favorable in the portfolio today, 90 investments, so reasonably diversified, 0 non-accruals. We do not own any of the companies we've lent to, very little PIK income, which means all of the income that we're earning in cash that we're then paying to you it is real. Our PIK income is very low, and I think this is indicative of just our selectivity and conservative structures. On the next slide, you lay out the industry diversification. We're very well diversified. This is something that's really important from a risk management standpoint. Any one sector could be a great place to invest, but we're not paid to take that risk. And so diversifying, even though we have deep experience across these, is important. 99% first lien senior secured and 98% lead and joint lead arranger. We believe leadership is really important.
Question, Teresa,
yes.
from Trustee Vasquez.
Yeah. Regarding your PIK exposure, which is low, which is great, obviously. But on the following page, you have a phrase here, PIK toggles, options to accrue interest. You explain to me your mechanics. What is a PIK toggle?
Great question. So a PIK toggle is a newer innovation, again, in the larger mid-market primarily, where borrowers have the option at inception to decide to PIK interest 50, maybe 100 basis points for a short period of time. And so in the way that we think about PIK, there's really no good PIK, right? We're first lien senior secured, and we want to be paid in cash. And so what we've focused on is using PIK as a tool, and I can talk about what we've done in deals that have gone sideways. We're using PIK as a tool to incentivize the sponsor to put in additional capital to do something. And so our PIK income is very low. The PIK toggles, we don't limit ourselves by size. The vast majority of what we do, we start in the lower mid-market as those companies grow. But there are situations where we have companies that grow from 20 to 120 million of EBITDA. As we do incremental financings, they might have a small portion that they can PIK, but that's not core to our strategy. That's not what we think is a prudent way to invest, if that makes sense. But you see that even in the 350 to 750 million facility size in the market, 16% of those deals do have a PIK toggle. So this is a new phenomenon that's quite prevalent as you get larger.
Are you doing cash flow evaluation or collateral?
So we value cash flow and we value multiple ways out. And so we generally don't like to think about liquidating our companies. That's not going to be a good answer. But we look at what is the collateral worth? How does that help us invest or not? But collateral liquidation is not going to be the primary way we seek repayment.
Last question, dividend recaps?
We do dividend recaps very selectively. It is not a core strategy of ours. And Generally, we're focused on dry powder that sponsors have to support their businesses, and we like to finance growing businesses. If you're growing, taking money out generally doesn't line up.
Thank you.
Other question? Can you address just briefly the role of within Fidelity and within companies that you lend to for diversity, gender, ethnic, CEO pay, things like that? What how important are those?
So we believe that we're not an ESG fund. We're not an ESG fund. We don't have diversity targets.
I didn't say history.
Oh, no, understood. But what where I'm going with that is even before that was a term, we believe good investing is having good governance and understanding where the company, who's running the company, what their incentives are. I've talked a lot about our incentives today. We think that's really critically important. And we don't run the companies or control them, but what we do before we close every investment is we have our own due diligence, investigation, background check team that was set up within Fidelity. I've never had anything like this either. They run background checks on every single management team member and the companies themselves. We are very focused on who we lend to, and it's not just before we close, but those management team members are added to our database, and searches are run on them constantly. So if there were to be things that come up, we know what's changing in that dynamic. When we look at how incentives are aligned, not only for the private equity sponsor, but for the management team. So again, we don't want lender liability in driving compensation or directing the sponsor as to how they should set up their management teams or boards. But we do want to make sure that everyone's rowing in the same direction. And so understanding how much, if an entrepreneur is selling their business, how much capital are they taking off the table? How incentive are they going to be to come to work? What is their incentive if the company performs well? How do we ensure we're retaining and recruiting talent? So those are things we evaluate. We also work with a third party to do an ESG review of each one of our companies. So understand their board governance, understand the private equity sponsors board governance. And so all of those things factor in certainly in every investment that we make.
We have about 5 more.
Okay, great. I can talk about the 100 deals we've done that have gone really well, but I'd rather talk to you about one that didn't go well and how we've worked through it. This is something I've prided myself on in my career and in our team's career. We have over 300 workouts that we've worked on. And that doesn't mean that we do a lot of bad deals. It just means if you've been doing this for a long time at scale, you're going to have issues. And it's not that will you have issues, you will. It's how do you deal with them when they happen. This is truly an art to work through these situations. This business had performance headwinds, drought conditions in the markets that they were serving. And this was, we talk about lower mid-market. This business was squarely there, but it was a scaled business. It was 100 million of revenue. The challenges that they ran into, we saw coming before we had a covenant default. We had a very low covenant level, so we were back to the table early. But even before we had a covenant breach, we were engaging with the sponsor, with the management team, relaying what we thought the issues were. What are they going to do? What are we going to be prepared to do? That dialogue and relationship resulted in significant cash equity coming in by the private equity sponsor, almost a third of their, increasing their investment by almost a third of the dollars that they had in. We were able to adjust the risk, the pricing of the risk for our investors by charging fees in exchange for giving them time to work through their issues. We had them engage a financial consultant. I have deep relationships with turnaround consultants within the lower mid-market, and they were able to engage a consultant. And part of our underwriting thesis, I mentioned origination is when you make mistakes. Part of our underwriting thesis here was that this business had been around for 50 years and that there was going to be significant value to strategics to buy this, which did prove out in the end. We were able to, with our credit agreement and our structure and our collateral protections, that they couldn't really do a lot without our consent, sit down with the managing partner and say, we understand what you're trying to do. If you want to continue to own this business, you're going to have to put in probably double the capital you've already put in. If you have the ability to sell, we think you should pursue that. And the structural protections we had and how we were able to structure the amendment, they came to us and said we have 4 strategics evaluating this business right now. And ultimately, the relationship we had with them, how we handled the negotiation, pushed them to sell one division of the business for over $60 million, which resulted in a full repayment of our loan, all of our fees, all of our interest. Importantly, we would never had a payment default here, and we only picked interest on a portion for 2 quarters, despite the fact there were multiple quarters. So to the point on the philosophy of PIK, I'm first lien senior secured. I need to be paid in cash. If you can't pay me in cash, then we have a different conversation. So I think this is a great example of, leveraging our relationship, our role as the admin agent and the structural protections we have to get to the best outcome. Again, working for the investor, not the private equity sponsor, which is a key distinction in our marketplace. Any questions on that? So lastly, just to wrap up, when I think about the long-term horizon that you have and the fiduciary responsibility you have, and having been in this market for a long time, I can tell you how personal this is for me and for our team. And we bring to bear all of the heft and scale of Fidelity to each one of our investments that we make and our ongoing portfolio management to protect our investors' capital. And anyone can scale a lending business. It's very easy to lend money. You just say yes more. And I can assure you that, with the power of our platform, if we wanted to be 5 times the size of what we are today, I could have done that by now. That's not how we're building this business. We're building this business to be here when I'm gone, when everyone is gone, that 25 years from now, we look back and say, look how proud we are of what we did for our investors. And so it's a very different mentality, and we bring to bear resources of a scaled asset manager to the traditional lower mid-market. And we would be honored to, manage your capital and really appreciate you hearing me talk for 26 minutes. So any other questions that you have, would welcome them.
Thank you very much, Therese.
Thank you.
Art,
Thank you.
great to
Thank
see
you.
Thank you.
We're going to take a 10-minute break until 10:15. I'm going to ask that we resolve all the paperwork issues so we don't have any more disruption. at 10:15 and do a quick review of middle market, vertical, and managers.
Cause, anything you want to add before we?
Sure. Yes, I'll be very brief. Middle market direct lending. So that remains the core of most institutional private credit portfolios. So in this space, borrowers are generally large, much more diversified and more mature than lower middle market companies, but still offering a meaningful illiquidity premium relative to public credit. So viewing this segment again as a core rock within private credit and a true balance of income generation, but again, an acute focus on capital preservation. I won't go into the managers right now. We'll hear from them, but happy to answer questions afterwards. Thank you.
Okay. This time, let's go ahead and welcome Mike McGonigal, Sean O'Keefe, and Elliot Honaker of Audax Senior Loan Fund 1.
Thank you. Thank you for the opportunity to be here today. My name is Elliot Honaker. I'm on the investor relations team based here in California. So again, thank you to Marin County. Thank you to Callan for having us here today. I'm joined by Mike McGonigal, senior partner and one of the founders of the strategy of the Audax Senior Loan strategy we'll talk about today, as well as Sean O'Keefe, one of the senior members of the investment team. So given time, we'll jump right in and have Mike come on up.
Good morning, everybody. Thank you, Elliot. Appreciate it. And thanks, everybody, for the opportunity to present this morning. I'll jump quickly into it. My background very briefly. I started in this business in 1986 as an associate in a leveraged buyout group with GE Capital in New York. Came up through the credit side of GE Capital, including a number of years in a dedicated workout group, and joined Audax Group in 2007 to launch this strategy. Audax Group was founded in 1999. We have two distinct businesses. There's a private equity business, which is run in Boston. They are currently investing out of Fund 7, and they have $20 billion of AUM. The private debt business is run out of New York. We have $28 billion of AUM. Most of that, 25 billion plus, is in senior secured debt, first lien senior secured debt, and we'll go a little bit more into that specific asset class. We also have a little bit over $2 billion in junior debt strategies, which is mezzanine capital for investors who have an appetite for that specific strategy. We don't commingle those strategies. We think they're very distinct risk return profiles. We'll go a little deeper on private debt, the private debt business on this page. If I think about one of the key questions, obviously, for you as you're meeting us and a bunch of different managers, what's different about us? This is all that we do. And so we lend direct lending into U.S. middle market companies. That is our lending strategy. We've done this since our inception for over 25 years. We focus specifically on core U.S. middle market. That definition has changed a little bit over the years. It's generally speaking today that low end has always been $10 million. It's moved up a little bit. The high end is now approximately $100 million. But that's really where we focus. We also focus on lending to private equity sponsor-backed companies. Sean will go a little bit more into why we think that's a good niche for us to lend into. We think private equity sponsors are good owners of companies. We have some metrics on the right-hand side of the page. You can see some of our numbers in terms of investment professionals, transactions closed, things like that. The key probably on this page, the key thing for us to communicate is that, the second really thing that separates us is the experience and the focus that we bring. What really matters in middle market lending, as you can see at the top of this page, is experience, scale, and relationships. And there's no shortcut to that. You have to spend the time on it. And our team has focused on this, some of us for 25 years at Audax, a lot of us for years before joining Audax. And that really gives us the personal and institutional relationships that matter when it comes to the front end in terms of sourcing the transactions that we're looking to source, as well as the relationships for working through portfolio companies as you're trying to deliver a return. And so we have that experience from having closed over 1,300 transactions and supported over 295 different sponsors in our 25 years at Audax. We have a snapshot of the investment team here. The senior leadership are the different private partners or the different managing partners who have founded the business at its outset. We've organized the investment team by the key functions that we think drive return in a lending business. And so we have the origination and capital markets function, which manages the front end and drives that front end of the business. We have the underwriting and monitoring of the portfolio, and that is actually driving the return once you've closed the investment. We have a dedicated group of individuals who focus on softer and problem accounts when those do occur. And we have a fund management team who really focuses on the third thing about us that we think is different. Our business model is focused on evergreen structures. And so we manage over 20 different evergreen vehicles. Our first vehicle, Senior Loan Fund 1, that you're considering was launched in 2007. And so that vehicle has a 17-year track record at this point. And we have a complex, and Sean can dive into this a little bit more, but we have a complex of evergreen structures that actually benefits the LPs in terms of a J-curve, but also by having a number of vehicles that are open to buy, you can allocate across those vehicles that all have appetite for an investment. So there's a number of advantages that come from that. The team was built with a focus on credit skills. You know, one of our core philosophies that you'll hear more about is our belief is that the single biggest thing we can do to drive return in this product is avoid losses. And so everything we do in terms of which loans are we sourcing, how do we underwrite, how do we monitor the portfolio and drive return is driven with a focus on loss avoidance. And so as you're looking at this investment team, a lot of the senior leaders worked together at GE Capital. Most of the senior members came through restructuring and workout teams, and so they've got that experience. And so this is a team that's very focused on the first lien product. They understand what makes a good loan. They understand what makes a good borrower, and they understand the pitfalls of the product and how do you drive return on a first lien portfolio. I'll finish with this page. It's titled Compelling Opportunity in Middle Market. What we'd like to probably leave you with here, though, is this is a cohort of borrowers that we have been lending to for over 30 years. And so this is not a point in time where there's an opportunity to lend into middle market companies. By some counts, there's hundreds of thousands of middle market companies in the United States, and they've always proven themselves to be good borrowers. The thing that drives it is, there's some sense that it's an inefficient market because they're smaller companies. It's really a market that's gotten much more efficient, but it's a market of inefficient companies. And so these are companies that are smaller. They don't have access to the public markets. And so they've always relied on private market financing. And so this is not a new opportunity. These companies have always existed, but they finance themselves with a different roster of lenders. Used to be the banks, used to be the large commercial finance platforms. Now there's, through a number of different systemic changes, there's an opportunity for non-bank lenders to provide this capital. And so these are companies where you get a higher yield because of that inefficiency. You actually have, we believe, safer structures, and you have attractive terms and attractive loan documentation in terms of rights and protections and remedies if something goes wrong. And so if you look at that senior secured debt column, in today's market, we're seeing spreads of 9 to 975 or total yields of 9 to 975, low leverage multiples, and importantly, very high sponsor equity contributions. And so with that, I'll turn it to my colleague, Sean O'Keefe, to take us through the rest of the presentation.
Thanks, Mike. And thanks again, everybody, for having us here today. Quick background on me. I've spent the majority of my career here at Audax, which is pretty consistent with most of the names that Mike would have shown on the investment team page earlier. So I've been here for almost 15 years. Prior to that, I was at Goldman Sachs for 2 years, and then I had joined the private sector after spending 6 years on active duty in the U.S. Army. I'm going to pick it up right where Mike left off as far as what our investment strategy is at Audax Private Debt. And the upper left-hand corner, Mike hit a lot of the highlights on why we like the core middle market companies. It's a robust opportunity set for us to lend into. There is an illiquidity premium, there is better documentation, and there are better structures. And so we like to focus on that part of the market as we have for over 25 years. Going a little bit deeper into the sponsor element, as Mike mentioned earlier, we do think that the stewardship that a private equity sponsor brings to these processes is a credit positive. We are putting our money to work in the safest part of the capital structure at the same time that the private equity sponsor is putting equity in at the bottom of the capital structure. And so we like that alignment of interest. We like that the private equity sponsor has raised funds, that there is capital to provide support to these businesses if there is any underperformance. And importantly, there is an observable track record that sponsors have that we can lean on as we're doing our underwriting and our due diligence. And I'll go into a little bit more detail on our underwriting process on some of the following pages. As far as the industries are concerned, the one negative filter that we have in our screening process is we avoid the highly cyclical industries. And so we're not lending money into oil and gas exploration type businesses. We're not lending money to faddish retail, utilities, banks, for example. And so once we pass that first negative filter, we're really looking for a very diverse array of industries that we're supporting, where we can look at observable cash flows from the individual businesses as we build that portfolio from the bottoms up after that initial industry screen. And then lastly, on the lower right-hand side of this page, we have solutions within these capital structures within our organization, which we think helps with our front-end ability to source more transactions. The majority of the capital that we have deployed, as Mike highlighted, has been in that senior secured first lien tranche. But the ability for us to sit in front of a sponsor with a singular credit strategy where we're looking to play at different parts of the capital structure, we think make us a more compelling partner for those sponsors as they're looking to finance these buyouts. On the underwriting side, you can see the filter here on the left-hand side of the page, and our goal is to source as many opportunities in the market as possible. And so we will see anywhere from 1,500 to 1,750 transactions in a given year. And because we are bringing in that many opportunities, we try to have a very efficient way to identify the ones that we want to invest in versus the one that we do not. And so as you can see in the first step of this funnel during our preliminary diligence, we end up killing about half of the opportunities that come into our pipeline. The primary reasons for those you can see on the upper right-hand side. We look at the historical performance. We look at the type of transaction. If it's not a buyout, a de novo buyout where we can get that alignment of interest, those are not as interesting of an opportunity for us. We look at the pricing. And one of the more prevalent reasons for us to pass on a transaction is we'll look at the adjustments to EBITDA that the sponsor is looking to lend off of. And so some of those initial screening opportunities, we look to cull down that list as quickly as possible. Yes, sir.
Question here from Trustee Silverstein.
So I know that you look at 1,000 or more things each year, and you only underwrite about 5% of them. It seems what everybody is doing, only underwriting 5%. What happens to the other 95%? Where do those people go to get their money?
There are folks out there that are at certain points in time that are willing to be more aggressive. There are some specialty lending shops that might look at some of the industries that Audax, for example, would be avoiding. And so it's mostly just finding a different opportunity. You know, we're not fully aligned with our other peers. We think that we can differentiate from our peers on some of the things that we don't do, particularly in some of the the more popular industries. So I'll give you a recent example that's been very much in the headlines. There's a lot of software businesses that are acquired by private equity sponsors. And there's been a very popular transaction type of recurring revenue loans where you're lending money to a business that may not yet be cash flow positive. That's a transaction that Audax has not been comfortable doing, and we have not done any of that type of lending. There's been a lot of managers that are willing to do that type of lending. They are willing to take that type of risk. And so I think that that's probably the best example to describe that those companies might be fine in the long run, but that's not what our strategy is, not to lend to those types of businesses.
Thank you.
In that spirit, of the deals that you do, how many are, what percentage are private equity sponsored, and are any of those deals from the private equity side of the Audax business enterprise?
That's a great question. 100% of what we do is sponsor backed. We do like that alignment of interest between us and a private equity sponsor. And so that's been the strategy from the beginning. And we do not lend to the private equity business in any way. And that would include when they're looking to sell a business, not just when they're looking to acquire it. We also won't look at the opportunity on the back end as well.
Thank you.
The middle part of this page is when it starts to get a little bit more competitive as far as how we're underwriting alongside the timeline of a sponsor ultimately acquiring the business. And so with some of these fancy logos, we've highlighted some of the high-level credit features that we're looking at within each of these transactions. I'll highlight a few. We're looking at the competitive dynamics that company is going to be facing within their industry. We look very heavily at the documentation. Mike highlighted how within the core middle market that documentation is more lender friendly. And so we're very focused on that. We're looking at the sponsor's track record. We're looking at what level of support they're looking to bring to the deal as far as how much of a check they're willing to write to acquire this business. And then as you highlighted earlier, we ultimately end up approving about 5% of the deals that we originally source. We close on average about 80 transactions a year. And so as Mike mentioned earlier, the entire business model was set up with an evergreen structure in mind. Our flagship fund, the one we're putting in front of you today, has been around for almost 20 years. We are constantly in the market looking for new opportunities. We're not sourcing specific opportunities for specific portfolios. We are implementing our strategy across any deal that comes into the funnel. And ultimately, if we like the credit and risk return profile, this fund, alongside many others, will have the ability to invest in that opportunity. And so we ultimately do about 75 or 80 transactions a year. And with
Typical term.
the stated maturity is 6 to 7 years. The typical turnover is 3 to 4 years. So on top of new capital coming in on a monthly basis and the ability to recycle any repayments that we receive, and this is one of the benefits of the evergreen structure. If we're fortunate enough to work with you all, we would call the capital within the first month. So the port, you would immediately be generating that run rate return. And then anytime a loan repays, we're then going to go and put it out into the next opportunity that we source. So there's a constant turnover of mitigating vintage risk within the portfolio as we are actively in the market looking for opportunities.
So typically, over the course of 5 years, all the loans that you started with work out.
That's right. And we have 2 more pages in the formal remarks. This one really just highlights the rigor because it's very easy to go out and source the transactions and put the money to work in some ways. But where we think we differentiate ourselves further is the ability to monitor that portfolio and make sure that we get the money back. And so the many, many words on this page really just highlights what we think are best-in-class practices around monitoring the portfolio, identifying potential risks and pitfalls early as we might see some underperformance on a handful of loans in our watch list, and making sure that we're spending the time where you all would expect us to spend the time within the portfolio as we monitor the credits. And then lastly, just before we can open it up, this has been the performance of our portfolio coming out of the pandemic back in 2020. And it's honestly very interesting because it really does align with, I think, what we've experienced within the U.S. economy. Over 95% of the revenue of the borrowers that we lend money to is generated within the United States. And so while there is a lot of geopolitical noise and macro pressures that we're all facing globally, this portfolio does tend to insulate itself quite well because the majority of the revenue is being generated here within the United States. But you can see that V-shaped recovery, steep coming out of the pandemic, and then a slowing but positive growth rate throughout the 2021 through 2025 time periods. And we've gotten ourselves back on track where we typically see this type of portfolio perform with a kind of mid to high single digits growth rate on the revenue and the EBITDA side. And that concludes the formal part of the presentation. And I know if you have any additional questions, happy to take those.
Okay. I don't see any women in senior leadership in Audax. Is that there are a number in other in the core investment functions. Is that something that goal?
So I went back to the team page to answer the question. If you look in the underwriting and monitoring section, Colleen Longobardi is a managing director, along with Chelsea Aron, who's a managing director. They are both in the, they're not named partners, but they, as senior members of the firm, they lead the monitoring function of the portfolio. And so while we don't call out those distinct titles, they are responsible for the performing portion of the portfolio. And so they lead that effort for us internally in a leadership capacity.
PIK yield versus cash yield. Can you explain what are your figures for both?
So the overall cash yield of the portfolio is right around that 9% level right now. One thing that we did not mention is these are all floating rate loans as well. And so you do take interest rate risk out of the portfolio. And as we continue to face some inflationary challenges, we think that that'll be very important to have here in the next couple of years. On the PIK yield, we don't think that PIK belongs in a first lien product. The percent of revenue that this portfolio that we're putting in front of you is coming from paid in kind interest is just 1.5%. There's a lot of public BDCs in particular that are seeing that level in the 10 to 20% range, kind of depending on the portfolio. Ours, we think, is market leading in the sense that it's only 1.5%. It's actually 1.6% for this fund.
Collateral valuation versus cash flow valuation. How do you handle it?
On the valuation side, we have an internal proprietary model. There's a portion of the portfolio that we use a third-party source because there is enough observable activity within the small club that there is a mark that can be observed. It's on less than a quarter of the portfolio. The level 3 assets, the ones that we can't value in that way, we have a mark to model where we set the baseline at what we underwrote. So, hey, we're comfortable putting money out at this credit profile. How has that performed since close? Those credit metrics that we evaluate is leverage through our investment, total leverage, fixed charge coverage ratio, interest coverage ratio, and liquidity. There's 2 market metrics that we also apply, which will be the spread of that asset relative to what the market clearing spread is at that point in that period. And then the last one is we do a TEV coverage where we look at public comps, which is much more conservative versus private transactions, and we apply that coverage to that asset as well. We then send on a quarterly basis, we send 20% of that portfolio or 25% of that level 3 portfolio out to third-party advisors to validate or confirm our level. We've never been outside of the bound as we've valued those assets. And so over a 4-quarter period, the third-party services would ultimately touch every one of those level 3 assets.
Engage in dividend recaps?
We will if it's within a transaction that we have already underwritten and we were in at the beginning of the LBO. It's something we've known well. We're comfortable. It's less than 10% of what we do, but it is not a meaningful portion. and it is not something that we will do as an entry point into an opportunity. We don't think it's prudent to put money in as the sponsor is taking their money out as our initial investment.
That's, you said 10% of the portfolio.
Less than 10%
than
of the
10%.
transactions that we do are dividend or opportunistic.
They're all de novo.
Correct.
Thank you.
Other questions? Go ahead.
Yeah, I'm sensitive to the public-private parts of your slide. I don't know exactly what's public and what's not, but so if this is something that you prefer to go.
If it's part of the confidential, you've received advice on this. If it's part of the confidential presentation, which I can tell you if it is right now or not, then you should not bring that up unless they bring it up first.
So we can't discuss fees, for example?
If it's part of the public,
Like I said, I'm not sure what's public and what's private. So, can we discuss fees or not?
if it's in their public presentation, you can discuss fees.
It's not, I don't think it's in the
It's
public.
not in the public presentation.
We have been very competitive relative to our peers on fees. We have been ahead of the market on where we apply the fee basis to. So without speaking numbers, because I don't want to get out of bounds on that front, we've always charged on the equity that has been committed to us, whereas I think the market for a very long time was being charged on the AUM that's being managed. We have always managed this fund to the equity or the NAV value of your investment. We have fees breaks for size, and obviously we have an existing relationship with Cal, and I do believe that the plan would benefit from, but that's without getting into specific numbers. That's directionally how we've historically lined up on fees.
And when something blows up or something deal goes bad, who takes care of that in your group?
So we still have the team chart up on the page. We have a dedicated restructuring group the way we do it is we have a cradle to grave approach. The team that underwrites the transaction actually stays with it through the monitoring. We don't have a handoff. So if you did the underwriting and you made the decision to lead that investment opportunity, then you live with it through the monitoring. If it does start to move into the direction that you're describing, the restructuring group will be added to that. We don't like knowledge loss transfer. So the restructuring experts, as far as how to tactically ensure that we get our money back, they will be added to that investment team and start having those more deep negotiations versus displacing that investment team. But we do have a dedicated restructuring group of 6 professionals. And then as Mike mentioned, him as well as the other senior members having built the team on credit skills, there's a tremendous amount of experience beyond just that dedicated restructuring group.
What's their track record as far as recovery?
Our recovery rate is in line with what you would see in middle market companies. So one of the other reasons why we like middle market direct lending is the historical recovery rates are around 70 cents on the dollar. But the reality is it is a very barbell result. And our very simplistic view on first lien lending is that if we are right on the business model, then we should not lose money as a first lien lender. And that has been our experience in most of the instances. We've had to restructure about 30 of those 1,300 transactions that Mike highlighted earlier. So a very low default rate within our history. The vast majority of those, we've outperformed that average rate, but there have been a handful that are on the lower end because there was a miss on our part on the business model. And so it's been less than a handful that fall into that group, but that's how you ultimately end up around that 70 to 75 cent recovery. Our historical loss rate is just on average 4 basis points per year, dating back to the inception of the business. So everything that we've described to you all today, and hopefully you take away, is that the business model, the strategy, everything that we do is really focused on the capital preservation point that I know Kaz had mentioned even in the intro as we were entering the room as part of the kind of core middle market strategy.
I have a general question. So going back to the 5% acceptance rate,
Yes.
when more and more money comes into the fund, will that push you to take more risk to put this money to work, or what's the strategy?
You know, that's a great question. And we spent a lot of time certainly over the last few years, as there's been more and more direct lenders that have come online. We're one of a smaller group that's been doing this for as long as we have at Audax. And there's been a lot of folks that have come in and they've started to do different things, and they've tried to become everything to everyone. They've become more asset gatherers than staying pure to what we've done, at least as far as staying within direct lending. And so while Audax, like many others, have aspirations to grow, our growth rate has always been in line with the private credit market. We've not looked to outpace the growth of this market. We've not looked to grow AUM by doing different things. We've stayed true to our knitting as far as maintaining focus on the core middle market. As far as your specific question, we are on average about 25 to 35% of the capital structures that we are investing in. And so as more capital comes into us, we don't expand our credit box. We will look to move that 25 to 35% range to 30 to 40. We will look to put more money into the capital structures that we are already investing in. And that's really where we've seen our growth, not by going off and now all of a sudden we're going to start lending money to oil and gas exploration, or we're going to start doing recurring revenue lending. That is not the way that we've grown the platform. It's by doing more in the types of transactions that we like.
Thank you very much.
Thank you all.
Thank
Thanks
you.
very much for your
Thank
time.
you.
So as we transition to the next manager, let me just cover a couple of things. If you're wanting to follow the presentation, that's the public packet, and you all have a copy of it. I sent that to you yesterday. That's the presentation that they're giving. If the material isn't in the public packet, then it's presumed to be in the confidential packet, which you also have. But if you're trying to match what's being shown to you today, that is in the public presentation. The materials in the back, if you grab those are the public presentations that are in the back. Fee information is in Callan's confidential due diligence report. So if you want to reference that information, you can go to the confidential Callan due diligence report, which has an overview of the company along with other details.
Thank you, Jeff. Let's go ahead and invite in Newberger, Berman, and Eagle. Everybody, thank you. Thank you. Okay. Okay. Wonderful. All right, we are right on schedule. Let's go ahead and welcome in from Newberger, Berman Eagle, Dan Ronsenberg, J.C. Gibbons, and
Susan Kasser will be on video.
got
Hopefully you can see me and hear me.
it. Susan Kasser on video. All right, we can hear you.
Awesome. Well, thank you. Thank you all for the time today. My name is Dan Ransenberg, and I'm the client advisor for Newberger Berman, serving institutional investors, including yourselves. I'm joined here by my colleague, Susan Kasser, the head and founding member of our team. She has decades of experience. She founded the business. Before that, she was a founding member of Carlyle's mezzanine debt team and a senior member of her team, J.C. Gibbons. Sincere apologies, Susan wasn't able to be here in person today. Our annual general meeting is literally today in New York with lots of our clients. So she was just off the stage earlier today with a number of clients, and she's heading to an LPAC meeting with this exact fund we're talking about today with a number of clients just after this. But I know we have just a short amount of time, so I want to start by thanking you. Thank you and Callan for the opportunity to present today. And thank you all sincerely for the great work that you do for our county. I've lived here in Marin for the past 19 years, and to be approaching full funding with a conservative 6.5% discount rate, really great work. Really proud of everything you've done for the organization and for the county. I've spent my career working with pension plans. I started life as an actuary. I was at Johns Hopkins with your actuary, Graham Schmidt, actually. I've worked as an investment consultant. I've worked as on investment teams, and then for the past decade or so as a client advisor. Today, if I put myself in your shoes, what really matters? What matters is protecting members' benefits, obviously. In the direct lending context, what matters is in the investing front, sourcing capital, protecting that capital, underwriting, good underwriting, and if things go bad, being able to help work things out. But beyond just the investing side of things, I think the structure is very important. So like thinking about leverage, we have strategies, vehicles that have no leverage or one times leverage, be conservative or careful, I guess, with more than one times leverage. I think that's an important structural piece. And then another structural piece I'll mention just briefly is the reason you're investing in an illiquid asset is because there's a premium that's paid over liquid assets. And there's no alchemy in the world. You can't have an illiquid asset with a liquid vehicle. That's what's caused a lot of the problems in markets recently. So our vehicle does have a longer lockup than some's, but we think that is important to not mismatch the liquidity. And also another key feature here is that 99% of our investors, or everyone in the vehicle that we're talking about today, is institutional investors like yourselves with long time horizons. With the time we have, we're going to focus on the why we believe Neuberger Berman would help the county's pension plan protect member benefits. 3 main things we'll focus on. One is the resources of the firm that help Susan and her team. The second is ultimately we can be pickier than other managers and we can go through that, but it's because of where we sit in the private markets ecosystem. And the third thing is obviously the team and the portfolio. Over the past 13 years, the team has grown from nothing to 25 billion in assets. They've experienced 0.01% defaults. They've really had an amazing job just building some of the leading sophisticated investors around the globe. So with that, I'll start. Any questions, I guess, before I get into just a couple minutes on the resources of the firm? All right, great. So on the resources, if you flip to page 3 of the presentation. Oh, I guess I'm flipping, sorry. So this is Neuberger Berman in a nutshell. So what we do, we exist to manage money for institutional investors like yourselves, about 222 billion in public fixed income, about 148 billion in public equities, and then 193 in alternatives. That's where Susan and JC and her team sit. Why does this matter to you? It matters because there's resources to help Susan and her team ultimately source new deals, to underwrite. So for example, if they're doing a comparable with a company that's on the public market side, they can talk to the public markets business. It helps if things do go bad, which they rarely do, but if they do, there's a big team to help in kind of underwriting or working things out. Beyond the business that we run, a few points I'll mention at the bottom is that we have an 85-year history investing. We're 100% employee owned. This is a differentiating factor. 800 employees fully own the firm. Everybody at the VP level and above has the opportunity to buy in the firm. Everybody in Susan and JC's team who's a VP level and above has bought in. I'm an equity owner. So it really creates a great culture. And that comes through in the box on the bottom right here is P&I, Pensions and Investments, does a survey of employees at organizations every year. And for the last 12 years, Neuberger has been rated either first or second best place to work among organizations with more than 1,000 people. So this ownership and autonomy that's given to teams really leads to a great culture of happy employees. And then here in Marin, I think we understand the benefits of happy employees. What does it lead to? High retention. You can see 95% retention at the firm level. Within our private markets team, it's even higher, it's 98%. Within Susan and her team, they haven't lost a senior member since inception. So very high reception, great performance, as I mentioned, 0.01% defaults for Susan and her team, but also happy clients. A lot of long-term happy clients. We're working with 13 of the 25 largest public pension plans in the U.S., a number of counties and cities in California, including San Jose, San Joaquin, Santa Barbara, Alameda, and others. So, just really great clients, long-term relationships that we build with our clients over time. So that's really kind of it on the business that I wanted to mention. The last piece that I'll briefly touch upon and then hand it off to Susan is our differentiation. What I think is probably the single biggest differentiator for us. And that to do that, I'll dig in. So within the alternatives business, I'll flip to page 5, and you can see this is our alternatives business. And what this business is we basically partner with other private equity firms. So similar to Abbott and Pathway, your partners are on the equity side, not the debt side, but on the equity side, we invest in their funds. So we are the client to private equity firms. So if a private equity firm is looking to borrow money for one of their companies, they have a lot of direct lenders they can go to. They have a lot of great relationships with a lot of people. And every time a direct lender is deciding, should I, bid on this or not, there's two decisions. One is it a good investment? And then the second is, well, if I say no too many times, will they keep coming back to me, asking me if I want to invest? And for us, fortunately, because we're the client, we can say no again and still have the opportunity to get the looks because we're a client on the private equity side. So I think that's the single biggest piece. My understanding is that's exactly why Susan chose to found this business at Neuberger many years ago. And with that, I'll hand it off to Susan.
Thank you, Dan. Let's go back to the first page. Sorry. One after that. Thank you. And I apologize. I have to correct Dan. Our loss rates are 1 basis point. Our default rates are 3 basis points. And the reason that loss rates are below default rates is that when you're a senior secured lender, you are first in right of repayment, which means you are last in line for losses. So even in the worst mistakes we've made across our 14-year and $25 billion track record, we've still managed to recover 2/3 of our investors' capital. So normally I don't start with that, but I just had to correct that one number. What we would be doing for you in our Eagle Fund, if we were so fortunate to be chosen, is to invest your capital entirely into very high quality companies in the United States, 100% owned by private equity firms, with a very strong bias to quality and capital preservation. The capital preservation focus is proven to date by our low default and annualized loss rates. We run very diversified portfolios. Today, there are 43 companies in the Eagle Fund. As it continues to scale, we expect it to get to over 100 loans. All of our past programs have managed to do that. Everything here is a private loan that we are privately negotiating the terms of. We lead or co-lead 98% of the loans that we make. That means we're generally the biggest, second biggest, or third biggest lender. We will invest money in companies that have 20 million of EBITDA, 50 million of EBITDA, 75 million of EBITDA, and 100 million of EBITDA, because the market is competitive enough that there is not consistent advantage, in our opinion, being at one size. Much better to cast a very wide net and look for the specific industry, company, loan, and private equity owner that will provide good returns for our investors in the context of capital preservation first. On average, the loans that you're exposed to in Eagle so far are about 75 million of EBITDA. Really a first lien portfolio, but we distinguish to you the difference between first lien, where there might be junior debt under us that we are not providing, and unitranche, where the only debt in the company is our debt, and there's a little bit more debt on the company in terms of senior secured first lien. Dan had mentioned our institutional investor base. In this program, it's 100% U.S. institutions. Across our entire program, it's 98% institutions and global. This fund participates pro rata with all of our other funds. And as evidenced by the fact that it is 43 companies versus 100, it is in process of being ramped up. And what's great about that is many of the concerns that you are reading about in the newspaper have to do with older investments. So for example, investments done in 2021, which was a very risk-on environment, investments done maybe in 22 before interest rates were high, investments done in 23 or 24 when people didn't have as sharp a lens on AI risk as they do today. In contrast, this fund began investing in 2024. It has no problem children in it whatsoever. Skipping to the PIK question that Audex received earlier, this fund today is generating an 8.51% cash yield, and the PIK in that fund is 0.03%. So I think that reflects the quality of the program and also the timing. This will allow us to continue to invest your capital, if you choose to invest with us, into an environment that has gotten significantly better over the last 3 months, in part thanks to all the terrible news articles. Last thing, Dan had talked about this. This portfolio targets levered net returns. We always talk about net returns because that's what you experience, of between 9 to 12.5%. And we get there with no more leverage than 1-to-1. We believe that you should be able to achieve your objectives with as low leverage as possible. And today, on average, across our portfolio, we're running lower than 1-to-1. If we can move, thank you, to the second page. So I just want to make sure that everybody understands what we have here because it is truly unique in the direct lending ecosystem. Almost all direct lenders are either pure play direct lenders, or they could be direct lenders sitting next to controlled private equity. That's what I had when I was at Carlyle. Or they could be direct lending sitting next to various other strategies. What we have at Neuberger really is unusual. We're sitting next to private equity fund investing. And since all of our companies are owned by private equity firms, that gives us an enormous leg up in terms of sourcing. We can easily source across the 890 private equity funds our colleagues are already invested in. We could also source across all the private equity funds they're not invested in today, but perhaps they will be in the future. Dan talked about the advantage it gives us on selectivity. We can say no thank you with impunity because Neuberger is not solely a lender. We're also in many ways a strategic partner to them. And then last but not least, information, and this is incredibly important. We have information about any company that is owned or has been owned by private equity. And we only can do that because we're such a large and longstanding fund investor. We also have information about the private equity managers themselves, the funds. This is very important because when you do diligence on a company, you will of course interact and meet with the management team. That management team can and will be replaced at the drop of a hat when the private equity fund chooses to do so. And so if you don't understand the private equity fund's performance, track record, experience, their strong points, their weak points, and their incentives and alignment with you, you are making your investments a little bit blind. And no other lender would have this information. We only have it because Neuberger is managing $55 billion as a private equity limited partner investor.
Then we have a question here from Trustee Vasquez.
Susan, thank you for that. Quick question. It sounds like you're all, by doing these deals, you're also doing sort of a ad hoc diligence on the private equity manager. In terms of governance, and this is just for my own edification, how deep is the diligence, and do you even get board seats? Just tell us a little bit more about that as you're scrubbing the deal as well as the private equity manager.
Thank you for asking that. So our colleagues whose job it is to invest in the funds, they're scrubbing the private equity funds. We are scrubbing the underlying company, utilizing all the information that we have. So think about the information you would get on a company when it's for sale. The analogy I like to give is when we sell a home. So the sell side broker is going to say the best possible things about the home. They're not going to take you down to the basement and point out where there's some damp in the corner. That said, if you spoke to the owner and you were the best friend of the owner might very well share some of that information with you. They might not, but they might. And so Neuberger's relationship is also an investor in the fund, which means we're getting fund level reporting on a company. I'm not saying that the private equity fund is going to highlight whatever mold in the basement there is about their underlying portfolio, but they are far more honest than a sell-side banker would ever be. So that's step one. Step two is our private equity fund of funds colleagues are doing diligence on the private equity funds. They're looking at their track record, partner attribution. We're seeing, is this last fund a good fund? Is this last fund largely realized, unrealized? Are they good at healthcare? Are they getting into healthcare, but they don't have a track record in healthcare? Oh, they used to have a track record in healthcare, but it didn't go so well and they fired that partner and they don't do healthcare anymore. So we have information like that that's very helpful because when we get to the stage of analyzing a company where we say, okay, we love the industry, this is a value-added business with a reason to exist, defensible margins, et cetera. The private equity fund wants 5.25 times leverage. This company's cash flow can support it with a lot of margin of safety, right? If something unexpected happens, a pandemic, a recession, rising interest rates, war in Iran, et cetera. Is this the right owner for this business? So if it was a healthcare company and we knew that this private equity fund did not have a consistent, strong track record in healthcare, we would pass.
You take board seats.
We do not take board seats in the companies. That's not common for direct lenders. Our private equity colleagues do take LPAC advisory board seats for the private equity fund investments.
Thank you.
Okay, no more questions. You can continue, please.
I think with that, we'll move to slide 6 and thank you all for having us again. Just to walk through our investment process in a bit more depth. Susan touched on it. The first step is we need to understand the private equity firm that we are partnering with, and in direct lending, particularly in private equity backed direct lending, ownership matters deeply. So Susan touched on the diligence process for the sponsors that we partner with. The actual process of underwriting the individual assets that will hopefully eventually go into this portfolio, it's bottoms up fundamental underwriting. We're taking apart these businesses to understand them at their base level. What are their revenue drivers? What are their cost structures? What are their unit economics? Who are their competitors? Who are their suppliers? We're focused on investing in market-leading businesses that have mission-critical products and services. These are businesses that their customers cannot do without the product or service they're procuring from these businesses. You think about the inflationary period we've all experienced over the past 3 to 4 years. Our portfolio has held up remarkably well, and it's because of those mission-critical products and services. If your customer runs their day-to-day operations on whatever it is that you're supplying them, they're going to pay whatever price increase you pass through because it's a mission-critical product and service. What we do not want to do, and what you would never see in our portfolio, is a business that's providing something very commoditized that dozens of other businesses can provide. Those are businesses that, in all likelihood, in a recession or in a severe inflationary environment like we've experienced, they're likely going to struggle. We avoid those types of businesses. Once we've screened the business for, again, revenue stability, cost structure, competitive landscape, the next step is thinking through how would a business like this fare in a very difficult macro environment. So whether it's a recession, a period of rising interest rates, a tariff war like we've all experienced. And we're not just doing this based on some hypothetical scenario. We're using the data that Susan mentioned that we have based on the private equity firms that own these businesses, see how they performed over 5, 10, 15 years. In a regular way sell-side process, when an investment banker is selling a business, they'll usually give you 3 to 4 years performance data. Well, that's not very helpful if I want to understand how a business fares in a recession. The last real recession we've experienced in this country was the financial crisis. COVID was very acute. It was a short period, and most businesses bounce back very quickly. We want to understand how businesses fare in a prolonged downturn. And the point that Susan made is very crucial. We're building capital structures that are conservative, that can support the cash flow characteristics of these businesses. And in an environment where you see prolonged softness for 1, 2, 3 years, ultimately the loans that we're making will be okay. That's the benefit of investing at the top of the capital structure. It is the safest part of the private equity ecosystem. Ultimately, our collateral and the recovery value for a loan in a workout, which is of course something we're trying to avoid. We have the right to take ownership of the business. It's something that we're avoiding at all costs, but we do have the ability and right to do, and I'll get into that in a bit more detail further on in the presentation. But what our ability to be selective and really cherry pick the best assets leads to is a very high quality portfolio. Quality is a nebulous term. We try to put numbers to it on this slide. If you look at the light blue bars in each grouping here, those are 2024 and 2025 US leveraged buyouts. So that's the broader market. The dark blue bars in each grouping are the Eagle Fund we're talking about today. Those are the loans in this portfolio. And you'll see that on average, the Eagle Fund is more or less in line with the broader market. from a leverage perspective. And the reason for that is what our relationships with private equity do not allow us to do is get off-market terms. Those private equity firms have a fiduciary duty to get the best execution they can. But if we can match terms with other lenders, we are able to pick only the loans that we want to make, and we'll never be forced into making a loan we don't want to make because of risking access to future deal flow. And what that means is we end up with a very high quality portfolio. If you look at the enterprise value multiple column on this page, the broader market, private equity is generally paying about 11 times earnings of a business to acquire it. For the loans in the Neuberger Berman Private Debt Eagle Fund, on average, they're paying about 17 times. So there's materially more value being paid by the private equity firm to acquire the businesses in our portfolio than there are in the broader market. What that means is if you look at our loans versus the broader market, on average, the loan to value in the Eagle Fund is about 33%. The broader market is closer to 50%. If you think about a home mortgage, the average home mortgage, the bank is putting up 80% debt and the homeowner is putting up 20% equity. In our loans, it's the exact opposite. We, as the financing source, are only putting down a third of the value of the business, and the remainder of the equity is coming from the sponsor. That drives a tremendous alignment of interest between us as the lender and the private equity firm, because they're making these investments with the goal of doubling or tripling their money. But as the first lien lender, they can't double or triple their money until we've been repaid in full. What that also means is in periods of underperformance, you're very likely to see the sponsors support these businesses with additional equity because they have so much invested in their original investment. We've seen over $1 billion of incremental equity support by private equity firms in instances of underperformance in our portfolio over the 13 years that we've been doing this. Over that same time, we've only had to put in $50 million of incremental capital. So the vast preponderance of support has come from the private equity firms that we partner with. And then if we touch on the team, and you'll see here, this is the team that is dedicated to managing the strategy day to day on behalf of our investors. And if we're fortunate enough to partner with you all on behalf of you and your underlying pensioners, the senior team that's in place, Susan, Matthew, Mike Schwartz, and Will Proctor, have been with the business since inception. Susan, Matthew, and Mike are the day-to-day leads of the business on the investment side. Will Proctor is responsible for managing sponsor coverage on behalf of our platform. And then the gentleman you see along the right-hand side of the page are our other investment committee members. And the investment committee for Neuberger Private Debt is quite unique. You have the deep credit experience of Susan, Matthew, and Mike, who've been doing this for decades. You also have deep private markets experience from the other gentlemen who comprise our investment committee. Tony Tutrone founded the Neuberger Private Markets platform over 20 years ago. David Kupperman runs alternative credit for Neuberger Berman. David Lyon is the head of our capital solutions business, and David Morse is the co-head of our private equity co-investment business. So you meld decades of credit expertise with decades of private market expertise, and you really get a very unique perspective. In terms of deal teams, on average, you'll have 3 to 4 members on a given investment, and the team that's responsible for underwriting a transaction and putting it in the portfolio monitors it through the close of an investment and ultimately through realization. We think the original investment team is best positioned to monitor loans because they are going to be the ones who are quickest to notice signs of underperformance. They know the management team, they know the sponsor. And to the extent we are in a situation where there's a need for an amendment or a workout or a restructuring, Neuberger has a formal restructuring committee in place that has 5 senior investment professionals from the private markets platform. They have decades of experience in private equity investing, loan-to-own investing, distressed investing, and they're a resource for us to the extent that we do need to go through a workout. But our overriding focus is, of course, avoiding those situations. And then I'd point out 2 statistics on this slide that I think are very unique for Neuberger, and really you won't see at any other direct lender. One is the 180 equity research analysts that sit within the broader $550 billion asset manager that we sit within. Dan mentioned it, but that's a very unique source of expertise for us from an underwriting perspective. Most other direct lenders are not within public asset managers that have a public fixed income business and a public equity business. If you want to get up to speed on a publicly traded company or a subsector of an industry that has publicly traded companies, you don't have great resources as a standalone direct lender. Neuberger, in all likelihood, has dedicated analysts that cover those sectors. And if they don't, Newberger is a tremendous consumer of sell-side equity research. So we could speak with a Goldman Sachs, a Morgan Stanley, and Bank of America. As a standalone direct lender, you don't get to do that because you don't do business with sell-side investment banks. And then our team is supported by 170 other private markets investors around the world. Some of the senior members of that group are on this slide, and this really serves as our sourcing army. Our colleagues around the world are having conversations every day with private equity firms about fund investments, co-investments, secondary private equity investments, capital solution or bespoke junior equity investments. And so while Will Proctor is our only dedicated sponsor coverage person, we really think of this as our sourcing army, and we believe it gives us the biggest origination capability of any direct lender out there because of this very unique private market platform. With that, those are the prepared remarks, and we welcome any questions.
Questions from the board? Okay. Excellent. Go ahead.
One more quick point, just because it's in the private deck, the confidential deck on page 14, there are fees, but the Callan discount, just to be clear, is 50% like lower than what is quoted in that private deck. So I just want to make sure that you are aware of that. But thank you again for the opportunity to present. As a longtime kind of Marin resident, really appreciate it. Brought my 15-year-old son here to learn a little bit about how our community works. So thank you all for the time today.
Thank you.
Thank you, all of you. Susan?
Thank you. Thank you for allowing me to participate by Zoom. Any other day, I would have been there in person with you.
Thank you. All right, we're going to adjourn until 11:30. calling to order the investment committee meeting. All right, now we're going to talk about some asset-backed finance. We'll begin with a review by Callan.
I can jump in here. I believe my camera is disabled, but I'm still here. Thanks for sticking with us. Next up is asset-backed finance. And so ABF, or asset-backed finance, that provides exposure to contractual cash flows, but backed by identifiable assets rather than solely relying on corporate enterprise value. So underlying collateral is quite a wide breadth, but some examples include residential mortgages, consumer loans, equipment leases, aviation assets, royalties, and some other specialty finance assets. And we at Callan believe ABF is one of the most attractive diversifiers within private credit and continues to benefit from bank retrenchment and an expanding opportunity set. So the purpose here is really just to continue diversifying away from corporate borrowers, from corporate lending. And yeah, the managers that you will hear from do exactly that and are very highly diversified and have great track record investing in asset-backed finance. So with that, I will open it up to the manager presentations.
Great, thanks, Cos. All right, let's go and welcome Keith Ashton and Tyler Riccio of Ares Pathfinder Core. Welcome.
Thank you. My name is Keith Ashton. My partner Tyler is going to provide moral support from the back of the room. And thank you for including us in this parade of suits that you have going on today. So I admire your stamina. I saw the agenda. That's incredible. By way of background, I'm a partner at Ares within the credit group, and I'll give you a little bit of a sense for where we sit. Ares, as I'm sure you know, is a very large credit-focused shop. We used to be part of Apollo back in the day, like, I don't know, 30 years ago. We were the credit arm of Apollo back then, and then spun out and became our own thing. And now we look like each other a lot. We've all gone re-expanded into all kinds of things. But credit is fundamental to what we do. We have a little under 650 billion, 2/3 of which is credit, and 2/3 of almost everything we do at Ares is credit. So I only emphasize that to say that mindset, sometimes I jokingly say you can identify a credit person because they're the one carrying an umbrella, even when it's sunny outside. That's just kind of permeates everything, the air we breathe, everything they do, the way we think about risk and everything. What we call alternative credit is these days called asset-based finance, or ABF, which is the term that's being used mostly these days, but it's what we call alternative credit at Ares. And as Callan perfectly described, the biggest differentiator between what we're doing and what our colleagues in the rest of Ares Credit are doing is we're not doing single name lending. We're not lending to a company or against a property or single name type investing. Everything that we do is based and backed by a portfolio or a pool of assets. And importantly, as Callan mentioned, those assets have to, for us, have to generate cash flows. So for example, we wouldn't lend against a portfolio of land because that doesn't generate cash flow. In fact, it consumes cash flow until you turn it into something that does. So everything we do is based on typically portfolios of loans, of leases, financial receivables, royalty fees, fee streams, contractual cash flows. And that's the basis of the underwrite when we're looking at transactions. We're evaluating how resilient those cash flows are, that credit is, underlying credit is, to stress. And we're only kind of investing in those sectors or opportunities where there's a lot of resilience and go through the GFC and be okay. So that's the basis of what we're doing. The fund we're talking about, Pathfinder Core, it's one of our flagship funds. It's focused on income and principal protection. So the cash flows that come off of these underlying portfolios, we're lending against those, and we're earning a coupon. And so it's a lot like direct lending, corporate direct lending, other than the fact that we're not getting cash flows from EBITDA, we're getting cash flows off of the underlying portfolio. And the yield that we're generating on our investments, which on a gross basis is kind of low double digits, we distribute that out to investors every quarter. So it's an income fund, the way the fund works. And then the principal that comes off of these portfolios, which comes in every month, is recycled, if you will, inside the fund to into new investments. And I'll go through the mechanics a little bit if you're interested, but that's kind of the way the fund works. And then, as Callan pointed out, this is a very diversified strategy. So we have a few of the types of assets that you might be just personally familiar with anyway, because you might have a credit card in your wallet or a mortgage on your house or a car loan or something like that. The activity, economic activity that goes on with everybody personally and commercially creates these kinds of assets that we're capitalizing with the fund. So that's essentially what we call alternative credit. There's a liquid side to this market, which goes by it's an alphabet soup in our world, unfortunately. So we have the liquid side, which is often called the asset-backed securities market. So think of these as the same kinds of investments, except there's a mediator, there's a bank involved that's creating securities and selling them, primarily to insurance platforms. This strategy and the fund really focuses on the private side of the market. We directly originate, not the underlying, but we directly originate the transactions that we're investing in. And I'll share a few statistics with you about that. There's some also other interesting differences between this and traditional corporate or any kind of corporate lending, which is the cash flow profile and the risk profile. So once we move out of single name risk into portfolios, we're in a very different risk profile to begin with. And then the other thing is depicted here on the bottom of the slide is a cash flow profile that's very, very typical and common in our world, which is what we'll call a front-loaded cash flow profile, which is depicted on the bottom right page of this slide, which is, again, different from corporate type investing where you make your investment, you probably don't see principal for a while. And then when you do, it's generally in one lump sum when you get taken out, a refi or company sold or something. Some event happens, it crystallizes your principal. In our world, that underlying pool of portfolios throwing off principal cash flows every day. And those cash flows amortize our note, our investment, our loan. And so we tend to see short transactions. The average life of the investments in Pathfinder Core is less than 3 years. So the investments themselves tend to be short and they're self-liquidating. So we're not reliant on a market. We're not reliant on an exit. The cash just, if we've done our job right, the cash just shows up and pays off our loan. So we're in a different risk world from that perspective because you have granularity in the cash flows that are coming at you and you have visibility into them because you're not waiting for an event to take you out in a number of years in the future. So consequently, what we tend to find, done well, done properly, is very, very low loss rates. We don't have it in this deck, but as a team and track record, which goes back a very, very long time, we've done, $80 billion of these kinds of private investments, and our annualized loss rate is 0.6 basis points. You compare that to virtually anything else, it stands up very, very well. It's investment grade quality, honestly. So that's, again, part of the nature of what we're doing. Each transaction that we do is in itself stress tested. And the way we kind of roughly think about it is we do a lot of quantitative and experiential work around those underlying assets to say, what kind of losses do we think that underlying pool might develop over its life? And I'll just pick random numbers. Like, let's say we looked at a pool and we think that 10% of that pool turn into losses. What we generally do in our transactions is we create enough credit enhancement, enough downside protection that we can handle 30% losses. The rule of thumb that we kind of use and kind of a standard is we want to be able to withstand 3 times more losses in that underlying pool than we actually expect. And then furthermore, we always ask this question. It's the first question of every IC. What if today is July 2007? What if the GFC is starting tomorrow? And we always want to make sure that our transaction can go through that, a replay of that horrible experience and come out the other side unscathed. And so we always have a nice margin of safety above and beyond even GFC type stress. And that's kind of the standard. So when you put these concepts together, you've got this granular underlying pool. It's throwing off cash flows. It's relatively short. You have this front-loaded cash flow profile. And then you have a substantial amount of credit enhancement that's protecting you in the case of things don't go to plan. And that's ultimately why the losses are so low. I mean, we're good at what we're doing, but I think anybody that's decent at this is going to be able to show low loss rates. And that's, I think, a good fact about ABF. Done well.
Can you explain this credit enhancement? Do you buy insurance or, I mean?
Oh, good question.
I mean, when the money is lost, it's lost. How do you?
Yeah, it's really simple concept. If I have $100 worth of loans, a pool of loans, I might only be lending 60 or 70 cents against that $100. So most of the credit enhancement, not all of it, but most of the credit enhancement is coming from the fact that I can have that 100 turn into 90 or 80 or 70 through its life, and I've still got plenty of collateral behind me. Think of it as like a loan to value. So there's a cushion that way. There's other additional enhancements, but that's the most intuitive one I could give you right now. There's other things, but that's the basis of it, is we're lending against pools, but not at 100 cents on the dollar.
But if there are no losses, then the return is higher, right?
It's higher for the equity. The whoever's beneath us, who's have put up that first loss, it would be higher for them because they probably assumed there'd be losses. But remember, we're lending, and our economics are, we got a coupon on our loan, and we got principal coming back, and the best we're going to hope for is par back and our coupon. It's a credit strategy. Make sense? Yes, sir.
And how is the collateral valued? How often by whom?
It's often not valued. Mostly because don't take this the wrong way, it kind of doesn't matter. What we really care about is not the value of that collateral, because we're not looking to sell it. No, there's an exception to that. Well, I'll get to in a second. It's the cash flows coming off of that pool is what ultimately matters. We got to know that those cash flows are resilient. What they might be valued worth at any given point doesn't matter as much, because we're not looking to sell that collateral to pay us back. Now, the exceptions to that are a few sectors that we actually tend to avoid, things like shipping or aviation, where there is value, there's a market for those underlying assets, and it's volatile. They're cyclical sectors, as an example. So you do count on the value at some point, and you're watching that like a hawk because you're counting on it. Most of what we're doing tends not to have any dependence on the value of that collateral. I'll give you an example. We did a deal where we financed a portfolio of shipping containers, the boxes, the things that go on the back of 18-wheelers. And the cash flows coming off of that portfolio itself, the way we did our deal, paid us back entirely. And at the end of the transaction, we could literally give those boxes away, and we would still have a nice return. So we try to put ourselves in a position where we're not reliant on what we call the residual value, the terminal value for any part of our principal. Great question. I want to pivot a little bit. I want to tell you a little bit about the fund. I want to make sure I'm not spending too much time up here either, because you've got a long day. But there's a couple of special things that we do. And one of this, it's depicted on this page, is what's called a relative value lens. And the way we invest, think of this as the philosophy or the strategy, is based on a couple of very, I think, obvious premises. One is not everything is equally interesting in this market. And whatever happens to be interesting today probably won't stay that way. So we kind of take a view. We have this incredible team. I'm going to talk about the team. We have like almost 100 investment professionals focused on this day in, day out. And we cover all of the sectors very, very deeply. We have the super experienced team. And what this team allows us to do is be objective about what's interesting or not. Where's the best relative value in the market? Where's the best opportunity? Where's the best risk versus worst risk? And we force rank all of the different sectors or asset types in our market. And this is a good sampling of those. And what's here at the top of the page is what we label in focus. So if you looked at our pipeline today, you would see many examples of things at the top of the page in focus. These are sectors that we think generally are pretty interesting. Not every deal, obviously, but generally. And then as you move down the page, there are sectors that we're spending less time on, if any. There's a few sectors at the bottom right that we say we'll never invest in them because they're incompatible with the strategy. This picture changes. In fact, I know Callan's done this. If you go back in time and looked at the same page from when it was updated a year ago or 2 or 3 or 5 or 7 years ago, things move, other than the nevers, things move around. And that's kind of the point. Nothing stays interesting forever, and not everything's equally interesting. The whole strategy is built around this. And because it's a relative value orientation, the way we deploy capital in the fund, we recycle the principal that comes off the portfolio, we're always trying to focus on the best part of the market opportunity and ignore most of the rest of it. And we end up in a very different place from a diversification perspective than other ABF strategies. And a good example of that is on this page here, where typically, there's always exceptions, typically, even with diversified strategies, you end up with a lot of consumer. And because it's easy to get to, because there's tons of it, and it's easy to access. And also, there's a lot of folks out there that actually own platforms. They own consumer lenders, and that's how they source the opportunities. So they end up with a large exposure to consumer. We look at consumer in the context of all the other things that we can do, and we're looking at it today, and we're like, not good. Like, there's a lot that we don't like. But we have 30 other things we could do instead. And so we end up in a different place from a diversification perspective because we're not married to any sector. And everything is subject to relative value. And the point I'm ultimately making here is not good, better, best, however you want to do it, but rather what a lot of investors have appreciated about Pathfinder Core is they invest in core, they invest in other ABF strategies, and they all tell us there's no overlap. Like you guys are doing, mostly what we're doing is proprietary deals, or at least deals that are not broadly syndicated. We generally don't do that at all. And we end up with a different allocation and different transactions than others. So we play well, this fund plays well in the sandbox with the other funds if you were looking to develop a portfolio of funds, which I assume you will. So this is just something you want to just think about because you won't have to worry about that internal correlation in your portfolio. Or you read a headline and think, oh, I've got this freaking everywhere in my portfolio. You don't have to worry about that with us. I'm going to tell you a little bit about the fund. And I also want to provide you a little update because this data is as of Jan 31, because that's the latest we had when you needed provided that information to you. But I have some updated numbers for you here. 11.8, which is how much we've deployed to date in the fund, is now 13.6. The realized proceeds, this is how much we've already recycled from the underlying portfolio in the fund, just to give you a sense of the magnitude. 6.2 on the top right is today a little over 7 billion. It's an engine for repositioning the portfolio to being nimble in the market. We have made 94 investments that are currently in the fund, up from 89. And our unrealized commitments, that 9 billion is actually 10.7 these days. It's just to give you some updated numbers from 12/31. This is a very mature, very diversified strategy that's targeting distributing between 8 and 10% per year, just income. The returns are a little above that because some of the returns come from occasionally fees and capital gains and a few other little things. Not a lot, but it's mostly income fund. I mean, it's been steady Eddie around the income and the performance. It's very, very, very limited correlation with anything you would have in your portfolio. That I can assure you. I think that's it. The rest of it is team stuff. And if you have questions, I'd love to answer any questions or concerns, anything you want me to address, I'd love to do that too.
from the board?
Your loans are fixed or floating? rate?
Great question.
Fine.
It's a mix. I'd say if you're just going to randomly do deals, it's probably 75% floating market. Since rates have been elevated for the last little while, we've really pushed to do more fixed rate deals, or where it's not fixed, we have high SOFR floors. So it's effectively fixed. And then we've done some things to protect yield, including to some extent interest rate swaps and some other things to kind of lock in minimum multiples on our transactions to kind of lock in the higher current yields that we're seeing today. So when we kind of put that through the calculator and say, if rates go down 100, what happens to our current yield? It goes down about 25 basis points. So it's acting today like it's 75% fixed, even though it's really not. But we recognize we're in an elevated rate environment. For how long, who knows? But we're trying to lock in as much yield because this is an income fund and that's the job.
And I notice on the footnote that says targeted yields is the 8 to 10%.
Yeah.
Should we lock that in our pro forma so that we know we're going to get that?
Yes, you can. I mean, our lawyers have to disclaim everything, right? But it is a strategy. This is not a new strategy for us. I've been doing this my whole life. 8 to 10 is, I can fall out of bed, do 8 to 10 in the strategy. It's really not that hard to do 8 to 10. And by the way, most of our track record that Callan diligenced was done in a zero interest rate environment. We are doing 8 to 10. So it's not even a rates thing.
We're going to talk to Apollo next. What do you do better than them?
I wouldn't say we do anything. I think there's a few things that we do different. I wouldn't say better. We respect the heck out of that team, and I'm glad to see that they're on the menu, and there's a few others that I may not be as excited about. I'd say one of the differentiations is, and I'm sure they'll talk about this, is they own originators. We do not. And that's, again, there's lots of pros and cons to that, but that's a point of differentiation. And I'd say the other thing is, in terms of these private transactions, we have more capital for doing these. Most of the capital that Apollo runs for the strategy is focused on insurance. And so it's not better or worse at all. It's just different. So that would probably be 2 points of differentiation, but I think they're highly complementary, which, to my earlier point, you could do both if you're going to end up doing both. I think it's a great complement, a great fit, no overlap. We're all doing proprietary deals. They're just doing it a little different. Their sourcing is a little different than ours.
When you say insurance, can you explain what you mean by that?
Well, it's just look at the balance sheet. Most of what Apollo and KKR and Blue Owl and Sixth Street, most of the capital that they have to invest in this space is for insurance. And so what they do is their transactions need to get rated, and they're generally investment grade, and they go into the insurance balance sheets. They generally, when they're creating those transactions, will create a subordinated tranche, if you will, and those subordinated tranches off of those deals tend to go into their funds.
Okay, so they're selling insurance?
They own insurance, Athene, like Apollo is Athene, a big insurance platform that's annuity and life company, and they're investing for that balance sheet. And the benefit of that, which if I'm going to put on my Apollo pitch hat, the benefit of that is it's massive, and they are able to see a lot and do a lot in the ABF market because of the size of the balance sheet that they have and the resources they have to do that business. And so the fringe benefit of that is they do a lot of these private non-rated transactions, and they're great. We just don't have the insurance tie-in. We just have scale capital and non-insurance capital. So the focus for us are these flagship funds. So it's just a little different approach to the market. And again, I'm not say good, better, best. It's just different. I think complementary in a complementary way.
Insurance would have a longer term, would you think?
It can, depends on the insurance. Annuities these days are selling, 3s, 5s. So it doesn't change. I don't think it changes the name. You'd have to ask them. I don't think it changes the tenor of the transactions. They might also, you could ask them, our average life in the Pathfinder course 2.73 or something years. I'm sure they know their number from their funds. I would be shocked if it was a lot longer than that.
Anything else from the board? Thank you.
Thank
Very
you.
informative.
Appreciate it. Appreciate your time. Thanks.
Thank you.
Oh, when you get a second, you should look at these lessons learned. We've learned a lot through the years. This is good stuff.
So, Mr. Chair, you're a little ahead of, you're 10 minutes ahead of schedule.
Thank you.
Lunch is here. I don't know if you'd want to get your lunch and then work through the next one, or if you just want to keep going. Your call, I just wanted to point out those options.
Is that an option to get lunch, have lunch while we listen to the?
Yes, of course.
Adjourn, get your food, come back. We'll start in 10 minutes. Back to the investment committee meeting. 12:05, and welcome to the podium, Dave Wright, Peter Swan, and virtually Peter Lees, eventually from Apollo ABF. Welcome, gentlemen. Thank you.
Wonderful. Thank you, everyone, and glad everyone has some lunch to accompany this presentation and some caffeine, Coca-Colas, etc. Peter Swan, I am responsible for our West Coast consultant relations and capital formation activity. I've been at Apollo for 7 years and I'm based down in LA. Excited to introduce Dave Wright, who's a managing director in our ABF and credit product specialist working with our West Coast investors, and Brett Lees, who's joining virtually. He leads our ABF business. He's based in New York, and he'll be joining by phone or Zoom, but really excited to spend some time with you today and very grateful to have this opportunity to speak with you. So over to Dave.
Fantastic. Is Brett on? Do we know if the Zoom is?
I am on. Thank you.
Fantastic. So David Wright, and it's a pleasure to meet everybody. Special thanks for having me here to present today. I was born and raised in Marin County, so it's a nice excuse to come back, and hope it'll be the first of many trips. Brett wanted to be here as well. We have Credit Week, which is a kind of credit strategy week for the business in New York this week, so he couldn't be here in person. And if the Zoom works, he's stuck in traffic. There was an accident from his last meeting, so he may only be audio. But I'd like to kick things off just with an introduction to Apollo very broadly. So we're $1 trillion asset manager. 750 billion of that is in credit. 300 billion of that is in asset-backed finance. So this strategy is absolutely core to what we do as a firm. I also want to bring your attention to the right side of this slide. So as you look at the Apollo business, you see Apollo Asset Management, which is the asset manager on the left side. The right side is Athene, the retirement services or insurance business. Athene is critical to the advantages we believe we have in asset-backed finance. Athene has a separate mandate in asset-backed. It's an insurance company, so generally it has to buy rated paper as opposed to the more opportunistic risk we take in the asset-backed strategy. But without Athene, we wouldn't have the scale that we have when we present to borrowers. We wouldn't have the size of the team we have. I'll talk about that later. We wouldn't have the data analytics infrastructure that we have. And critically, we wouldn't have the 16 platform origination ecosystem, which I'll also kind of come back to a little bit later. Let's skip that one and talk quickly about values, because as you think about who you partner with, hopefully it's important kind of what their core values are. So the Apollo ethos, purchase price matters, is simply value. We are a value investor. And I think as you talked to Brett a little bit about the portfolio, how we think about risk in this market, keep that in mind. Excess return for unit of risk, we are a relative value investor. So we think a lot about value across all the different sub-asset classes, which is very relevant in the asset-backed space. We look across different geographies. And also important, we look up and down the capital structure. So asset-backed can be equity-like risk, it can be debt risk. We're consistently looking for, across our entire ecosystem, where we think makes the most sense at a given point in time. And finally, alignment. We are a principal in all of our strategies. We have a larger GP commitment than others we know of in the industry. And I'll come back to that with some specifics, but that really permeates how we think about risk and how we think about our business alongside our LPs. So very quickly here, hopefully you're somewhat familiar with what's on this slide. What is corporate credit versus asset-backed finance? I'm sure you have some background from Callan, so I won't spend too much time on it, but corporate credit is effectively enterprise value lending. You're lending against a corporate balance sheet. Asset-backed finance, you're segregating those assets from the corporate balance sheet and lending specifically against those assets. And you can think of your mortgage, for example, often in a payment in the asset-backed finance space, there's a principal component and an interest component. So asset-backed finance, just to differentiate, one of the many ways you look at asset-backed finance versus corporate, it's a little bit shorter. The average life in the fund is about 3 years. This slide, we're really just trying to give you a sense of the scale of the market. So $40 trillion addressable market across asset-backed finance. This is the broadest possible definition. And you see this is just a partial list of some of the subsectors in which we play. We'll come back to that a little bit later. I'll Of that $40 trillion addressable market, about 600 billion is in funds. And just to contrast, I think you're looking at middle market sponsor-backed lending as well. It's an interesting space. That's about a $1.7 trillion market, of which about 1.1 is in funds. This kind of a fun slide would give you a sense of where you might run into asset-backed finance throughout your day. Permeates our lives, is all around us. I won't go into it more than that. This is a slide we put together on the underwriting process. Please ask us questions on it. I'm going to leave it to Brett to talk about structuring, diligence, and underwriting. This slide, I think, is really kind of the meat of the presentation, and I want to spend just a couple minutes on what we think makes us different in the asset-backed space. 290 billion is as of end of 25. We're actually at about 305 billion now. We have 17 years investing in the asset-backed finance space. Cumulative deployment is well over 450 billion since 2008. That covers the financial crisis recovery, that covers energy stress, that covers COVID, regional bank crisis, Silicon Valley Bank, and the recent rate hiking cycle. On top of that, there's been all kinds of subsector stresses in different parts of consumer around the world. You name it, we have seen it over the last 17 years, and that impacts how we talk about risk and evaluate risk. Critically, through that entire cycle, our loss rate has been 3.2 basis points on the 450 billion over that period of time. We think a lot about downside risk. Second, scale and resources. We are a large business, and we believe in having the flexibility to move across all these asset classes. We don't think you can do it without a large team. There are 200 plus professionals in the asset-backed business at Apollo. 17 of those are quantitative researchers. Data analytics and quant is very critical to this, cross-sector underwriting approach. So 13 of those 17 quants carry PhDs. We carry a scaled data and analytics infrastructure. I referenced this earlier in the context of having Athene that supports all our analysis across sub-asset classes, and I'll kind of come back to those. And finally, we leverage the broader Apollo ecosystem. And this is really critical. If you're kind of inside the four walls, this is something truly unique that you maybe don't see every day. Apollo has a no walls policy. So we can talk to our colleagues in private equity, we can talk to our colleagues in infrastructure, we can talk to our colleagues in real estate. And in fact, part of consideration and evaluation at the end of the year is how well did you work cross-functionally. So if we're looking at a data center deal, we might call our private equity team. They own Stream Data Centers. What do you think about this risk? Have you run into them in the business? How is the leadership team? Same thing, in fact, with the infrastructure team. If we're a data center deal, we'd probably reach across and speak to them. Second piece of that is they help drive sourcing. So global corporate credit is constantly talking to borrowers, distressed borrowers. They might have assets on their balance sheet that can be pulled off as a financing solution. They would direct that call over to us. Recent example of that is, for example, Hertz. We were involved in the DIP loan. We got a phone call from the corporate credit team. Hey, they need a solution against their fleet. They're public. No one wants to go and rent a 5-year-old Taurus from Hertz. Their fleet financings had gone into a rundown event because they'd gone into bankruptcy. They needed a refinancing solution. We also leverage sourcing teams. So we have teams that cover corporates directly. We have teams that cover banks, over 60 banks globally. We also cover our peers, other sponsors from a sourcing standpoint. Those teams drive opportunities across the business, and particularly in our world in asset-backed finance. Third point, alignment. I want to come back to that. I said I would. The direct employee and affiliate commitment in this strategy is $350 million. On top of that, adjacent to that, is a $500 million commitment from Athene, our insurance business, through an insurance rated feeder. We think that, I'll just reemphasize the point, we think that really impacts how we think about risk in the business, acting as a principal and aligned partner in adjacent to our LPs in investing. And finally, I'll jump forward here. Fourth key differentiator, I want to talk about the platform ecosystem. So I alluded to this earlier. We've invested $12 billion. We started very early doing this over 10 years ago in an ecosystem of origination businesses. So day in and day out, all these logos originate loans across the asset-backed spectrum. To give some context around this, Aegis is an equipment finance business in Europe. PKR is the old GE commercial air finance. Global business, 30-plus year history across aircraft lending and leasing. Alliance Supply Chain Finance business. Wheels has a 70-plus year history, going back to financing Pfizer trucks just after the Great Depression, bringing around medicine. Fleet leasing business. Aqua, consumer business. NewFi, a mortgage business. Atlas is the old Credit Suisse securitization business. It is the largest scaled asset-backed warehousing business outside of the banking system. So what that means is they help issuers across the full flavors of asset-backed finance put together enough loans so that they can go and finance themselves in the public market. So for example, someone might be making auto loans. You make one auto loan, you can't go out and issue a security against it. You need about maybe 9 months to ramp up enough loans so you can issue a security. Atlas provides that service. What is critical about this ecosystem is the values that it provides to us as an investor. So, I'd estimate in 2026, we'll take less than 3% of the origination off of these platforms into the fund. We'll pick and choose risks that we think is particularly attractive and are happy to have the option to invest in that. But the value goes far beyond that. So as we think about partnering with this ecosystem, we get data across millions of underlying loans. We get early credit warning signals, signs of what is happening at the point of origination. So just to give you some context on that, that might be now seeing in the consumer business. Fraudsters are using AI to create case stubs or false W-2s. We can take that information when we get a phone call from a consumer lender as a third party we may partner with. How are you addressing that? How are you prepared for that? We leverage that information across our entire business. The third piece is, again, sourcing. 4,500 employees work across these platforms, and they do something very specific. As I mentioned, Atlas is a warehousing business, but they're talking to lenders all the time. If they need a financing solution, we are going to get a first call and a first opportunity at that lend. Incredibly valuable to us. I'll just spend a couple minutes on sort of sourcing. Again, I want to give you a sense of what's in the fund. It's 80% plus private asset-backed origination. You may have heard this just hopefully from a profile of the business. Right now, that looks like about 50% direct origination, which is working directly with a counterparty on a financing solution. About 8% third-party partnerships. That's engaging in a term partnership with someone to take risk. And then the platforms I already talked about, that's about 20%. And critically, those percentages will move over time, and that permeates all of our business. Again, we're always looking for where the cheapest risk is and leveraging the entire platform to source it. And that's a good segue into the entire ecosystem here. So this slide kind of, I'm sure you've seen versions of this, maps out the entire asset-backed sort of arena. We split the world into 6 pillars: consumer finance, residential, commercial, hard asset, financial, and capital solutions. You can see a number of the sub-asset classes underneath. Critically, hopefully I gave you a sense of all the scale and infrastructure we have to step into these asset classes with confidence. You cannot be a tourist investing in these markets. You have to understand all the nuances of auto leases versus music royalty lending. And we will move up and down the capital structure. We'll move geographically. We'll move across sourcing channels. So this slide really alludes to that flexibility, which is really how we think about approaching the business. So with that as an overview, I'll take a pause. I can have Brett jump in, talk about the portfolio, how we're thinking about the market, risk. We have a case study on a GPU financing, a chip financing that we did recently. But I want to take a break and see if we have questions as well.
Trustee Vasquez.
Yes, thank you both for coming. I have a question regarding your relationship with Athene. You could elaborate a little bit more. I know that that's sort of the playbook nowadays. MetLife just bought PineBridge. Manulife just acquired stake in Comvest Credit Partners. So it seems like a lot of these players, insurance companies, are using the Apollo playbook, if you will. But my interest is in the extent to which the insurance side of the business, how much of the balance sheet can be used as a backstop for the asset-backed finance side of the business? That relationship between the two entities, if you will. And even on the insurance side, Athene, I know there's an insurance business that's registered here in the United States, but there's also a reinsurance operation that's registered in Bermuda.
Mhm.
So I'm trying to understand, should a blow up happen, where does the buck stop, really? I mean, kind of like, where's the final accountability? Obviously, you guys have a tremendous operation. You stay in the high grade field and terrain, but just really understanding that relationship and as to where the buck stops and the balance sheet for Athene. How much can we leverage that for the asset-backed products that you guys have?
Absolutely. So I'll kick off and I'll let Brett potentially chime in. So Athene is an independently regulated insurance company.
Sure.
And as I mentioned, it's got to buy rated paper. That is different from the asset-backed fund. We're very up in credit right now, which is a market view. We have a lot of flexibility and we've done a lot in more opportunistic, high yield, and even residual first loss type asset-backed risk. The insurance company generally needs to buy rated senior paper. As with all insurance companies, it has a roughly 5% bucket where it can buy, your insurance companies buying funds and others. There's no question that a number of market participants have in some way copied the Athene playbook, and you're seeing a lot of tie-ups, whether just partnerships or actually acquisitions across the insurance and asset manager world. But Athene is independently regulated. So it is very separate from the strategy that we are talking about today. What it brings, though, is that scale. So Athene is the anchor in a fund which owns the platform ecosystem, and these are long-term holds. This is an evergreen fund. We would only exit a platform if it were for strategic reasons. So hopefully that gives you some context on kind of the differences between the two. I'll mention one kind of live example. You might have seen in the press, we did a financing for Broadcom. I think this was announced about a week and a half ago or so. Athene will take a lot of risk on that. That helped us win that deal. And we ended up bringing in a competitor of ours as a partner as well. But having the scale to speak for a part of the transaction, and I think from their perspective, looking at someone that they know that can commit and sign creates confidence and certainty of execution. So there was a rated piece, which was Broadcom backed. There was another much smaller piece, which is Reliant. The counterparty credit is effectively the Anthropic lease. It's roughly 3-year Anthropic risk with chips behind it as well as collateral. That priced at 8.5%. So I think it's very likely the fund will take some risk in that. It's incredible risk. We could not have sourced it if we didn't leverage the team.
So, hi, it's Brett Lees here. So, very specific to your question and to supplement what Dave Wright said, right? We own Athene. Athene and Apollo are one. Athene has independent regulation and has a group of people who are the defender of its balance sheet. My job is I invest on behalf of Athene as a fiduciary. They're treated like a third party from that investment, but they are a very, very close relationship. Their size and scale, as Dave said, helps us secure wins when we originate. The fund and our LPs buy at the same price, same place, and same time as Athene if the assets are suitable for both parties. And so our investors benefit from the fact that we have a $400+ billion balance sheet that is interested in the same assets. On top of that, Athene has a very long time horizon in what it does, right? It's not looking over very short periods of time, and it is non-mark to market largely. And so it is able to handle volatility. Again, as we think about things that are suitable for both parties, is able to muddy through markets and make long-term commitments. Our LPs are all the beneficiary of that. Ultimately, right, if everybody's in the same trade, if there are losses, everybody shares them by the proportion of their capital. But we are not doing things to benefit Athene at the expense of our investors, and vice versa. All investments have to stand on their own 2 feet, and our duties as a fiduciary run the same to all parties. And so there should not be a conflict between the two, but the size, the scale, and the fact that we've been doing this for a very, very long time means that we've worked out many of the kinks that bedevil others. And as Dave Wright said, since we run an integrated business, there isn't somebody trying to just thread the needle for insurance, right? All assets have to present the right risk return profile with downside protection for them regardless of where they are going.
Excellent. Thank you for that response. Cleared up a lot of issues for me. Just a follow-on corollary question here. You mentioned mark to market. No pun intended, but your CEO, Mark Rowan,
Sorry.
early in the year, went public on many platforms in the media about your daily pricing of private assets, your new model. And I'm kind of curious about that because that differs a lot from other private market asset managers. And simply put, you don't have to reveal, every fine detail here, but my question relates to, will you make those estimates available to your investors on a daily basis? And I understand that it's not a liquidity event per se. And also, and the second part is, will you also make available sort of the methodology of that daily mark-to-market model for private markets, which I find fascinating in terms of, relative to what happens in public markets. So quite appealing, quite frankly, just the soundbite. But as we know, devils are in the details. So that's my second follow-on question.
I'm happy to chime in, but Brett, go ahead.
Yeah. To answer your first question very specifically, our CEO has made a commitment both to the external market as well as inside the firm that the goal is by 9/30, September 30, for us to put a mark on every asset every trading day, with full transparency as to what those marks are. As you noted correctly, a mark does not mean it is executable for the entire size of whatever your position is, just like any mark you see in a publicly traded market is only good for a certain size for a certain period of time. We will endeavor where possible to explain our methodology. However, we own thousands upon thousands of assets. I am not certain that it is entirely possible to go through the methodology for each and every one of those. But all asset marking starts with two things. The first thing, and this is the underpinning of the technology, is that all cash flows for every asset are then modeled in our system. They are saved down, and then they are given to our trading desk, who will then develop marks. And those marks will be based upon not only the expectation of forward cash flows, but also certain beta markers, such as movements in interest rates and movements in like spreads, where they be investment grade spreads, high yield spreads, or equity spreads. That is step one. And then step two, to the extent we have changed the characteristic of the investment, i.e. we added credit enhancement, for example, we shortened duration, we changed the cash flows, we will make adjustments to the mark based upon how risky or safe those changes make the investment. But one thing that you did mention, and I do want to harp on, is this idea of transparency is so important to us. And I think, as you noted, very important to investors as well. And we believe that a lot of what has happened in the open market, where you're seeing marks go from a very high number and they're cratering, while that is possible in certain instances when information comes to light, we do not think that that is the ordinary course of events. And we are trying to provide, effectively a very transparent counter to that. And you've seen that in the way we've marked private assets in our BDCs, for example. We've been very front-footed. So 9/30 is the target date. We are trying to hit that. I can't tell you that we'll hit it to the minute, but that is what Mark Rowan has put down as our target as a firm.
Thank you for your answers. I appreciate it.
Well, Brett, do you want to, we can jump into a case study, or would you like to hear a little bit about the current market, how we're leaning, how we've kind of built the portfolio for the current risk environment?
With about 5 minutes, let's talk about the current market.
Brett, you want to take the current market?
Sure. So, sadly, I've been doing this for longer than I care to admit through multiple cycles. The current market is about as bowled up and as tight as I can remember in a very long time. There is almost nothing that can't get done. Spreads are exceptionally tight. There's a tremendous amount of structural leverage in the market. and the amount of liquidity and cash that is coming to the market is truly exceptional at this time. That is actually being offset, however, by an insanely large amount of infrastructure spending, not only in digital infrastructure, but reindustrialization of the US and Western Europe, remilitarization of certain economies. And that is also happening at the same time that inflation continues to be persistent. And we believe that interest rates will remain higher for longer. The sheer amount of spend that's coming into the system is effectively equivalent to north of, we believe, 10% of GDP, which means it is a massive stimulus without having an external stimulus by the US government and a number of foreign governments. In other words, there's no stimulus in the form of falling rates, nor is there a stimulus in the form of government spending. Much of this is private sector spending, and the market is absorbing it. What that leads to for us is it means things that are happening in the private market, which are optimized for sale, are selling you very, very quickly because there are not enough assets out there for people to access to spend all the money they need to spend. And for the people that need to build up large amounts of infrastructure quickly, the checks are so large that a private solution is often necessary, because if only a few companies can test the public markets for deals of this size, deals of this complexity. And therefore, you need to provide scale creative solutions for people. So as a professional investor, it's actually an incredibly exciting time, but also a very stressful time given the absolute level of yield that you can get paid. And what we are seeing now is we're seeing the tail end of the legacy of other markets that have had that, which is the 2018 to 2021 market, where rates were low and most anything could get done in equity with high levels of leverage, much of which now needs to have a re-rack of the underlying valuation of those companies, which will lead to defaults in things like software and some other places. We think that it's actually moving more and more to an investor's market. If you have flexible capital, you can speak with size and scale and certainty. And most importantly, if you have an investment grade bend, the vast majority of the capital that is needed is in the investment grade side of the markets, not only for very large, highly rated companies, but also for governments around the world who are seeking to rebuild their economies. And so for us, it means that you should be appropriately cautious. You should know that, that with rates higher for longer, it means businesses that were relying on huge amounts of cheap leverage to work probably are going to have a long-term problem, that asset values are going to re-rack slightly lower over the near term as a result, whether that be in certain leveraged buyout companies or in certain real estate related companies. But we do not see a significant credit cycle turn in the future, save for two things that may concern us. Number one, as things kind of work themselves out in the Middle East, a much more prolonged conflict there, we think is bearish for markets. But also there is a non-zero probability that AI leads to widespread job destruction. Widespread job destruction. While that is our tail event, an unemployment-led recession is not a thing that we are normally seeing. So if you couple persistent inflation with large-scale job destruction, that is incredibly bearish and is one of our risk cases in the tails of this market. The evidence right now does not support that, but it is something we are watching. It is something we are mindful of when we think about where we play in the markets. That was kind of a very fast view of the markets. I'm happy to take any questions that you may have.
Thank you. Question from the board.
That's pretty scary.
The only point I'd add to that is the alignment point that I made earlier. Our portfolio is currently 81% investment grade like, 415 basis points of spread. After fees, that still is an attractive risk-adjusted return, coming back to that earlier slide on the Apollo ethos. So we feel very well positioned. We feel like we're generating very attractive risk, but we're not leaning or stretching to earn a performance fee at this point in the market, given those sort of tail risk scenarios.
It feels like at odds with what he was just describing, as far as there being so much capital chasing these yields and the spreads tightening and all that. Like, how are you able to get these spreads when there's You get so much competition for it.
Yeah, that's exactly why we're not leading into the high yield side of the book as much right now. Those typically are smaller pieces of an asset-backed piece of risk. There's more people competing for them. We're staying far away. We think about ourselves as makers of risk versus takers of risk. So we're not chasing pieces of risk out there that others are maybe competing for. Brett did mention, though, a lot of the demand is in the IG side of the market. And that's where we're sitting at 81% IG. So if we can source bilaterally a partnership that solves a problem for a borrower, I don't think we have time to go into the chip financing, but it's a good example. We can get paid very well for it. That's attractive risk in this market. We'll lean on our private origination capabilities. And we'll wait to lean in on risk until it's a better market environment.
And then there's another side of the market, just for what it's worth, where there are a number of assets which are difficult to handle. And so one of the reasons David was so focused on the platforms, whether or not we buy from them, everything starts with the asset from the ground up. If you can handle the asset in every form, whole loan form, warehousing form, public ABS, private ABS, pref equity, no matter what form the asset comes in, you're now solving people's problems. And the market gets very, very efficient over time in handling assets in different formats. But for example, if you take a residential transitional loan, which is not a normal mortgage, right, that may yield 300 basis points more than a traditional conforming mortgage. And there is a very limited ability to repackage that asset. Your average insurance company that buys whole loans doesn't contain the infrastructure to own it. And so it is therefore structurally cheap. We own over $6 billion of that paper. We have built all the infrastructure to handle it. And so if you think of yourself as a solution provider that is form agnostic, it is one of the better ways to get paid rather than simply taking more risk.
Okay, well, we're out of time, so I appreciate the presentation. Thank you.
Appreciate the opportunity.
Thank you all.
Thank you.
Mm-hmm. Bye-bye.
Thanks. There we go. All right, so we have heard today from 6 different managers from 3 different categories of the market: the lower middle, and asset-backed finance. We have an action item before us now. We can vote to do something or always vote to do nothing.
Let's do it again.
And what we choose to do would be choose between 1 and 6 managers. Maybe 3 would be a good number. So let's start with a wrap-up discussion, and let's include our friends from Callan with maybe some insights on what we just listened to.
Yeah, Kaz, you want to start with some observations maybe or direction here? I think just one thing from my perspective is I think the goal here was to identify a single manager from each of these as opposed to multiple. You always reserve the right to do something differently, but that was, I think, the original intention.
Agreed.
Yeah, happy to jump in. Yeah, we could start high level or go one by one, starting with lower middle market. But just to preface the conversation, as you're all aware, the managers shown today all went through a rigorous due diligence process, and I think we're in a great spot as far as selection goes. Hopefully these presentations resonated with you all. I know there was the gentleman from Ares mentioned that Apollo and Ares are complementary, which I would agree. And so given an estimated an estimated commitment amount, it could make sense to split those. I'm not trying to make things more complicated, but that would be the only area in lower middle market and middle market. I would say that those strategies are less complementary. So yeah, just throwing that out there. With respect to, I guess, just jumping into lower middle market, comparing Fidelity and Twin Brook. So if I guess may speak freely, again, we are comfortable with both managers. I would say maybe a little bit more comfortable with Twin Brook, just given their much longer track record and experience in dealing with some of these troubled credits, and having experience in completing the workout and restructuring necessary to preserve capital. Um, we've also seen that they have stayed true to their word in staying lower middle market and not being tempted, like we've seen with many other asset managers, in going up market and trying to, yeah, just raise these massive funds and put a lot of capital to work. We found that they've been, yeah, again, just true to the strategy. For Fidelity, we do believe that they will also stay true as well, but there could be that temptation to hyperscale and maybe go into potentially larger borrowers. But again, that is not necessarily our expectation. So yeah, both very high quality managers. I think we would slightly lean Twin Brook, but happy to have a conversation about that. And then we could also get into some of the fees and some of the discounts as well, which may drive some conclusive conversations as well.
Okay, thank you, Chris. And Jeff, what do you think would be a good way to come to it?
Well, I think based on what Jim just said to you, is that the original idea, not that you can't do whatever you want, please don't hire 6 men, is a manager from each category. So I would suggest, if, with that theory in mind, knowing that you do have a free palette to paint on that you want, is take it by category. And Jim can bring up the fee document that I just handed out, which is from your March pack. So there's nothing new here. This was in Alan's presentation to you back in March when you made the decision about which managers you wanted to interview.
Can you remind us, please, about the amount and the percentage? I know it's 60-40. Is it, say, did we decide 30-30-40? Or can you please run it through?
You did not. You said 60% direct lending, 40% asset-based finance. You didn't say that the 60 was 30-30, 40-20, 50-10.
Okay, and the 5% total amount was?
100 million, approximately.
Yeah, the way we had paced it out was 100 million for this vintage, and then we would relook at current managers and new other opportunities in 2027 as well. So it's 100 million total.
Okay.
The rough idea was to split the corporate lending equally between lower middle market. So that would be 30 each, with 40 to asset.
And from earlier, what we are looking at, these are confidential numbers. We should not discuss them.
These numbers were in your, this information was in your public packet from the March meeting.
All right, well, let's go this in sequence of
We could have had the discussion about these at the time I wanted to.
I think it's better served that it's done right now.
Okay, so let's go in sequence from the beginning with the lower middle market. We heard from 2 great managers. Does anyone want to make a comment on how they were impressed or not impressed by either of those 2? Did anyone have a favorite? And if you include the fees that we're looking at, does anyone have a favorite? Or
So I'll just say, my impression was that Fidelity was sort of new to this field and was ramping up its fund right now. And at least as I read, the IRR was higher for them than it was for TPG. But I think is it because they're just getting started? Whereas with TPG, it's it's fully fleshed out. We know what it is there. So
yeah,
those were the 2 trade-offs for me between those 2. Would you care to?
Yeah, I think those IRRs are a little apples and oranges. Just give it. But I think it's probably pretty accurate. Fidelity's platform is newer than Twin Brooks, which is much more senior.
And Fidelity is a big, private company. Whereas TPG is it's part of a public company, but this is a private, section of it. There.
It's a division inside a much larger, broader, alternative-oriented, publicly held investment. So, again, their history crosses over multiple different platforms and ownership structures over time. TPG is the most recent 4 years.
But they're pretty much independent, right?
We think they operate independently within the TPG structure. But have access to the broader TPG resources, which can be beneficial from time to time on various reasons for various reasons.
So, as we see here, a summary of fees. I know past performance doesn't mean much in the future, but did we have a summary of their performances?
Yeah, the performance was included again in a prior package, and they're all,
Mhm.
they've been successfully executed on
Okay.
their strategies and met expectations. So
Level field.
Yeah.
Okay. Any other
And I would just add your comment on Fidelity showcasing higher performance. That is very common to see in newer product offerings. And the reason for that is mainly due to the use of sublines. So a lot of that is smoothing capital calls, getting money in the ground and invested before LP commitments are made. And so there is again, the use of leverage there. But I would go back to also just looking at the terms and spreads in which these deals have been done. And so I would expect the net return for Fidelity to come down, and both strategies will be targeting a similar all-in net IRR.
And I'll just say one other thing. I like the higher hurdle rate at TPG. That means something.
And I would say I have intention to back the TPG.
All right, well, it feels like there's a move in that direction. Again, we're not talking about percentages yet. We're just talking per category, choosing who we might go with to put a vote together. So let's
Looks like it's gonna have to be a motion, put in some
correct.
amount of money to put one of these managers.
Thank you for stating the obvious. Middle market direct lending. We have the Newburger Berman Eagle and Audax Senior Loan Fund 1.
So we're gonna do one and then go to the other one, to the other.
We are, right now we're talking about the quality of managers and who we're gonna go with. We're not talking about
I
percentages yet.
think that, I think you could make a motion on each one of these.
Yes, it's
Okay,
easier.
so if you're set on something in the lower middle market, or you're comfortable with something, then make a motion in the second and make that decision.
Make a motion to allocate 30% to TPG Twin Brook DL for the middle lower category.
Silverstein will second.
Any more
The
discussion?
question is 33 or 30 or 3? Is it 30 or 33? What's the? I've forgotten what the allocation.
Again, that we're going to allocate, the intention was to allocate 60% of the allocation to direct lending, split equally between lower middle market and middle market.
So it's 30.
30,
right?
30, and then 40 to asset back.
Any additional discussion? All those in favor, raise your hand.
Mr. Chair, the motion to hire TPG Twin Brook Direct Lending Fund 6, 30% of the total allocation passes unanimously 8-0. Trustee Robbie absent.
Okay. Now let's talk about the middle market direct lending with Newburger Berman Eagle and Audax Senior Loan Fund 1. Did anyone have a feeling about those two presentations?
Well, I have a question here. So again, there's so many numbers here, and do I get this right? I thought Audax had a net IRR of 7.6%, and Newburger was 13.7. That's quite a difference. Are those things calculated over in different ways or time periods, or did I get that wrong?
Yes, performance is a little hard to do apples to apples. I think it's important to remember that the Audax SLF Fund 1 has an inception of 2007. So there was a very long period of time of very low or close to zero interest rates. So that number you're seeing for Audax is an inception to date number. So we did additional analysis trying to compare more apples to apples, looking across more of a 5-year mark to looking at, like 3-year, 5-year to try to coincide with the more recent rate environment and just where terms and spreads have been there. So that ended up being much higher than that inception to date of 7% there for Audax. The number is 11.1% net IRR for the Audax Evergreen Fund, looking at the trailing 5-year mark.
Okay, thank you. Same question. Did either of them impress or disappoint?
Does the lower management fee kind of, my gut tells me lean that way?
It's pretty significant.
Yeah.
Go ahead, Kyle.
Yeah, if I may jump in, I'm so glad you mentioned that, and this is something that I wanted to talk about up front. But you'll see that one is charged on net assets and the other on gross. So bear with me here, but that is very important because that takes into the account the effect of leverage. So Audax is charging 1% on net assets, which includes both the equity investment and leverage. So in more simple terms, if you look at Newburger Berman, that charges on gross. So how that would work is, let's say it's a $50 million equity commitment, utilizing a turn of leverage, that would be $50 in debt. So that 100 million actually turns into more of a 1% management fee. So that is a very key distinction, and they end up being very comparable then. So yeah, thank you for mentioning that.
How about the incentive and the hurdle?
Yeah, so Audax, again, through a much lower rate environment, has had a 5% hurdle for a very long time, and we of course expect that to be met in this case. So I think that is also very important to look at. You would of course prefer a higher hurdle rate, but you'll also notice that Newburger Berman does have a higher incentive fee of 12.5% versus Audax at 10%. So there will be a break-even point when it comes to net returns on when one becomes cheaper than the other. But all else equal, you would prefer a higher hurdle and a lower incentive fee. But here, they both somewhat go in opposite directions. So it does unfortunately become a it depends analysis, which we looked at from like a bear, base, and bull case. But again, the fees are quite comparable in that aspect.
I'll chime in here as well. I kind of look at the operation and the due diligence. I kind of lean on the Newburger Berman side. Their cash yield versus their PIK yield was a standout fact for me. It appears that they not only diligence their deals, but also their private equity manager sourcing deals. Not their own private equity manager, but the private equity manager from which they source deals. Compare that to Audax, where the PIK yield is more than double, and their dividend recaps, which I don't like either, 10%. Both are figures that kind of raise questions when I'm doing an apples to apples comparison within the same space, direct lending, middle market. So, and then I just think they have a broad and a deeper institutional capacity with which to execute on this strategy.
Thank you. Any other comments or perhaps a motion?
I will move, allocate 30%, Newburger Berman Eagle, middle market direct lending.
Is there a second?
Second by Mila.
Any additional comments? All those in favor, raise your hand.
Mr. Chair, the motion to hire Newburger Berman as your middle market direct lending manager at 30% of the allocation passes unanimously 8-0. Trustee Robbie absent.
Okay, we're moving right along. Now we are talking about the asset-backed funds. We heard from Ares Pathfinder Core and Apollo AB Cap. Something from Cause.
Yeah, I think the first point that I would talk about, which will be a key point of consideration, is Apollo's ownership model of the 16 originating and servicing platforms. It was stated a few times, but it truly is accurate that there are pros and cons to that approach. We found that by owning and controlling these platforms, it gives them direct assets or direct access to assets before the broader market can see them. So that can reduce competition and could potentially improve economics as well. And it could also give them better underwriting data because when you own the originator or servicer, you can see distinct loan level performance. While Ares does get very good insight as well, there may be some potential holes, but there are a number of considerations there as well. I think an obvious one is just the conflict of interest by them owning those platforms, because it begs the question if the fund is buying assets because they're attractive or because Apollo needs sort of a home for these affiliated platform originated assets. So I think that is important. And then certainly talking about Athene, as mentioned, they're going to have a bias towards much lower risk, lower return assets. So we stated in our due diligence report that we don't necessarily agree with the stated target net return that Apollo puts out. When you look under the hood, when you look at deals that they've originated, deals that they've done, and keeping in mind that it's over 80% investment grade and that Athene is a big beast that needs to eat and has a very defined credit box, we would expect returns to be substantially lower than what they state their target is. Again, I'm not necessarily saying that as a good or bad thing, because with expected lower returns comes lower risk as well. But I think those are the two main points of contention, is getting comfortable with Apollo owning those origination platforms and also the Athene balance sheet as well. So we've had a lot of discussions internally within our private credit research team. And again, to speak freely, we've been slightly more comfortable with a strategy like Ares over Apollo if we had to pick one. Just due to some of those potential conflicts that I outlined, and yeah, the Athene relationship as well. But again, very close. And also, I'll state it again that we do find these strategies to be complementary and would not expect a lot of overlap between the two.
Thank you.
I have a question for Callan. Do you think this massive deal that they just did with Broadcom and Blackstone has any effect on that particular portfolio we're looking at? I mean, it's like really a lot, 35 billion, and they're willing to hands in hands with Blackstone. I mean, probably I don't understand much of it, but does it affect what are we talking about?
Yes. Yeah. I mean, absolutely. Apollo, I mean, they or sorry, excuse me. There are a number of products and I guess call it mouse to feed. And so while it will have an effect, I think at the end of the day, you look at the diversification, not only across these single deals, but again, looking another layer into just the sheer amount of borrowers and line items that these funds have. And so these funds are constructed in a way where you really do have that safety in numbers, and diversification is absolutely key and paramount. So I think it goes back a little bit to the sizing and just understanding just what potential macro shocks could be headwinds in different places of the portfolio. And that's something that we've been comfortable with.
Okay, thank you. So a question here, comment from Trustee Werby.
Yeah, if I read the material correctly, we're reporting like a long-term IRR of 9.6% for Ares and 6.98% for Apollo. Is there any reason to believe that those are not representative?
I think that those are representative in the most recent environment. I think Apollo has been much more risk off, which is reflected. But also, yeah, just going forward, I have a bit of a harder time to believe that the portfolio will meaningfully change in the next couple years. And by that, I mean meaningfully change in the sense that they won't be able to, or that they won't have to feed Athene, and that they will be taking on increased risk and start generating returns north of 10%. That's something that, yeah, I just don't necessarily think that that will happen in short order. While we expect returns to climb above 7%, probably not into the double digits unless there's some meaningful changes.
I also noted in the footnote, if I read it correctly, that there's a 5% floor and a 7% cap on the hurdle rate for Apollo.
Yeah, so that is a somewhat of a new mechanism that I've been seeing over the last couple years. And that was made to be a bit more LP friendly because I'll use Audax as an example. They've had their 5% hurdle forever and just don't change it again because that was a product mainly in a zero interest rate environment. So investors were coming to a lot of these managers saying, hey, times are changing. We expect interest rates to be higher for longer. This hurdle rate doesn't make sense. So the response to that was implementing a floating rate hurdle which is based off of SOFR plus a premium. In this case, it is SOFR plus 3%. And the guardrails to mitigate any drastic changes in interest rates, both up or down, are put in place there. So that's the explanation for that hurdle rate. And while it's not incredibly common, I'd say in direct lending, I do see that being implemented more and more, maybe about 20% or so, and maybe 15% or so of strategies I'll see implement this floating rate hurdle, which I do think aligns pretty well with LP interest.
Yeah, costs, I hear your concerns about the lower risk, lower returns with Apollo. You know, if you're constructing a portfolio like we are here within private credit, you can make the argument that the two categories above are kind of where we would want to have more risk taking and searching for yield, if you will. But I'll take the other tack. I actually appreciate the fact that Apollo has been a bit more prudent and staying within the investment grade playing field. And I think there'll probably be more opportunities there. Credit cycles come and go. So my impression is that they're deep. They know what they're doing. They've been doing this well. They now have imitators. And I just don't see them deviating too much from their playbook. And while the environment is what's going to be generating some of those higher returns. This is just, I know, conjecture, but I kind of like what they have. So, and I like the fee structures and I like the lack of a lockup period. So should we ever decide to change our mind in 18, 36 months, it's not going to be a cumbersome onus task, if you will.
Yeah, certainly. No, I think that makes sense. I don't want to paint the picture that Ares Pathfinder Core is
Yeah.
taking on a lot more of risk to generate those returns. What I would say to that point is I think Ares will have an easier time rotating into pockets that showcase better relative value over the next couple years and have a bit more flexibility on taking advantage of some of these areas that might experience a dislocation or just might be more attractive. I think Apollo is a little bit more chained towards originating IG,
Right.
IG paper. Yeah. So just,
see-
yeah, just thinking of it in that lens.
Do you see Ares going down in credit quality? Is that what I'm hearing, the subtext?
Um,
'Cause
Potentially.
that also generates higher yield, but we're also incurring some default risk and such.
Yeah, I would say potentially, but I wouldn't say a lot because Ares has their flagship drawdown funds, which are a little bit less in credit quality, that do have some equity in there that target much higher net returns than this evergreen Pathfinder Core. So Pathfinder Core will always be a senior focused, high quality portfolio. So no, I don't expect the going down in credit quality to really enter the Pathfinder Core fund. I think that they have the ability to go into less trampled areas, which you could certainly infer that that means that others don't want anything to do with it, and it could be less quality. But yeah, I wouldn't say the expectation is for Ares to, yeah, to go lesser in quality to generate greater returns. This is truly a core conservative strategy as well.
So I tend to agree with these comments, and for that reason, I favor Ares over Apollo. I think they're more flexible. They've delivered higher returns, and I think that they know how to do these workouts, and there's very low default risk with them.
other chime in?
Just a quick question about the Aries 6% hurdle and 15% preference is justified, maybe justified is the wrong question, but I mean, do they have a reason why they're so courageous in there?
Yeah, like a reason for the higher incentive fee. Well, yeah, I guess talking on the hurdle first. Right now the hurdles just looking at current SOFR are pretty close. So yeah, I would probably talk more about the incentive fee. I think that you see this in a lot more of the, I'll call them market leaders or like the most established players. There is higher demand for those products that have a great track record, great team, and have showcased their ability to preserve LP capital and generate great returns at the same time. So I think, yeah, part of that is just more of an established team and player. Not to say Apollo isn't, but I think that would just be some of the reasons there. But no, you're exactly right. It is slightly higher, so that is a consideration.
Comments for a
Silverstein will make a motion to do the allocation to Aries.
saying 40%?
Yes.
Wait a second.
I'll second.
Additional comments? None, let's vote. All in favor, raise your hand.
Mr. Chair, the motion to hire Aries as the asset-backed finance manager at an allocation of 40% of the total allocation passes unanimously, 8-0. Trustee Robbie absent.
We did it. Wow, that's big. Okay.
And I understand that there can be some negotiation on some of these fees here and their discounts and stuff like that? Is that?
I don't think I think what you see is probably what you're going to get at this point in time. The economics may change in the future depending on sizing and things of that nature, but there isn't really negotiation at this stage. I don't.
One follow-up question for that. So we see here, economists, you negotiated the fees. Did you negotiate also the incentive fees?
Yeah, I can jump in. So that negotiation is in effect across all of Callan clients. So these managers take a Callan client aggregate to meet potential fee breaks. I will say that is not part of our diligence or our process to look at who's giving us the best fees. It is certainly fantastic when that all comes together. And as you would expect, the managers we showed forth to you are ones that we have high conviction in, and other Callan clients do as well. So the discounts is more so the fact of aggregating LP commitments, which reaches thresholds, which then benefit all Callan clients. While we can't say with certainty what fees will be going forward, as more commitments are made to these strategies, there is the potential for additional fee benefits, which can be implemented in future years.
To my point. And just to reiterate that, that's an important point. We do not start this process with fees. Fees is not the starting point. It's a fourth, fifth, sixth order discussion. Importantly, we do not demand aggregated or discount fees based on Callan clients. The managers come to us with those offerings, which I think is a big distinction. We're not leading with, hey, you need to give us this economics for aggregating our client assets to get to these fee levels. We don't think that that's an appropriate way to do a manager selection process. We're trying to find the best managers that fit client portfolios and produce the best net of fee returns. That's what's important, not the cheapest fees.
And do you have clients that demand or do the practice of negotiating before going in, putting the income?
There are clients that will be in that process. Typically, they are ones of much larger scale than MCERA that have the ability to create separately managed accounts, that are able to skirt most favored nation clauses and a whole bunch of other things. So yes, it happens, but that's not, yeah.
All of what Jim said, true. But to the extent that you make a decision, then it becomes a discussion amongst your council and their councils and our discussions with them. So we always have a discussion about what you said you agreed to the fee with. It doesn't mean we can't ask. Yulia can add anything that she wants to add to it in terms of discussion with the managers about fee.
Yeah, I would say my experience, if it's a separately managed account, or an investment management agreement or a fund of one, where it's a very large position that an investor takes, then, and that vehicle is customized and that relationship is customized just for them, then certainly they have the leverage. I mean, some clients are putting in into the billions into a particular asset class and selecting only one manager. Otherwise, when it's comparable to what you're doing, I don't see the incentive fee negotiated. The management fee, I do see negotiated more or less sometimes, or often can be, but not the incentive fee. The incentive fee is what the manager usually stands by. And to the other comment, there is, you have to look at gross versus net, because there is a difference.
Good to know. Thank you.
Okay, excellent. Now we're gonna get an investment manager update regarding Dodge Cox and UBS.
All right, we'll do this quickly since there's nothing major with Dodge & Cox. Just their co-head of securitized is departing the firm at the end of this month. Dodge & Cox manages their portfolios. They have a large investment committee that oversees all the portfolios. This gentleman was co-head of securitized, so there is another head of securitized that will be overseeing that area. But then also more importantly, Dodge & Cox's portfolios are more credit heavy. Securitized is more of a complementary position. So no major concerns here. Dodge & Cox has again, a strong organization, lots of backup people. So usually when there's a departure, there's lots of people in place and a strong team behind them that doesn't cause much concern. Of course, we'll continue to monitor as we do all of your managers all the time. Any questions there? The next one is UBS. So UBS is one of your core real estate managers. And they announced that Matt Johnson, who heads the U.S. real estate division, will be departing the firm to pursue other opportunities. And Larissa Belova has been appointed head of real estate. Now, Larissa is the head of the fund that you're in, the Trumbull Property Fund. She's also head of the chief investment officer for the U.S. real estate business. So this is adding additional responsibility to her. So she is overseeing all of the U.S. real estate for UBS. So that's one area to monitor, just, the additional responsibility that she is now taking on. Larissa joined UBS at the beginning of last year. She has a lot of investment experience, came from another firm and is a strong investor. We have seen, UBS we always talk about them. There's always updates on UBS and not a year goes by, it seems like, without one of these memos on UBS. There have been a number of personnel departures. The fund had been repositioned, but things look to be on the upswing. So, we'll continue to monitor this. Right now, their Execu is at 3.5 billion. So that has been dwindling down. Also, investors have been having rescissions from the queue. It's not like if you wanted to make a move, anything would happen immediately anyways, but again, something we'll continue to monitor. UBS and Larissa will be in December as part of your regularly scheduled manager updates as well. Any
Thank you
questions?
for the questions about that. Okay. About future meetings.
Yeah.
Anything, requests?
I do. I noticed international asset class. Still have a manager that's on the watch list. Don't know why. It's been 3 years.
You
now.
review your watch list every year in December. So
Excellent.
you have a process for that. When you get to December, there'll be a watch list. Alan will review the manager and make a new recommendation whether they should be removed
Every December.
every December.
Okay. And
Okay. Now someone had requested an update on the SpaceX IPO.
Yes, at a prior meeting, SpaceX was obviously in the news a lot. People have been talking about the initial public offering. The question was posed whether we would be able to not invest in SpaceX. On Friday, the IPO occurred. About 75 billion was sold, representing about 5% of the company. There were questions around changes in the index makeup. So there were rules implemented to quickly bring SpaceX into the index or index inclusion without the typical seasoning process. The index companies discussed that this would be to represent the market where these companies stayed private longer. What I would say is in large cap equity, the markets tend to be very efficient, and as a result, historically, the board has chosen to represent its large cap equity through a passive process. And in doing so, you are not making active decisions on a stock price basis. You defer to the index provider and the passive provider to implement that solution for you. Another thing to note is that given the size of the offering as a percentage of the very large company, its value at offering was around 1.75 trillion. Only a small percentage of that came to market, about 5%. So with that, the actual makeup in the Russell 1000, which is how you represent your large cap equity, is between 10 and 12 basis points. So with that, I think the historic decision to implement through a passive process means you're stepping away from that, taking individual stock positions. You do have the ability to remove a company if you should wish, but that would bring in other costs associated with it.
Do companies that we use to mimic the broader index, do they buy the stock at the IPO?
Well, in this case, you will be representing you're replicating the Russell 1000. So the Russell 1000 changed its rules for when it would be included into the index. The process for bringing in that new equity will be delayed a few days.
So it won't be brought in at the 150 price, it'll be brought in at a higher price.
Yes. Okay. So it'll be, I believe, tomorrow. Russell is including the.
So we won't get the bump that stock got.
It will be, yes. You're just passively replicating the market as is on the.
But as of not Friday, as of some other day.
Correct.
Yeah.
But as I understand it, the three major indexes show the R 1000.
Mhm.
Then there's the S&P 500, and there's the triple Q.
Yes.
So that when SpaceX enters into those three indexes, which a naive person would think would be at the same time, is not.
It's not.
Is not what's going to happen. So correct me on this, but I believe it's going to go into the R 1000 first.
I believe so, yes.
Uh,
Off the top of my
And,
head.
and so then there'll be another bump, if you will, when it goes into the triple Q, which I don't know exactly when it is, but it's later. And then there'll be still another bump later if it goes into the S&P 500.
As of now, I don't believe the S&P 500 has decided to include it, given its season, or it's not going through the accelerated inclusion process,
Yeah,
so that won't happen. But yes, there will be passive buying as it is included in those indices.
So I mean, we had a presentation from Dimensional way in the past about how these different indexes are constructed, and they're not all the same. And some people are jumping in early and whatever and so on. But in any case, it's 1/10 of 1%. It's as far as we are concerned, it's very much de minimis here. If it was 4 or 5%, I would be more concerned. As
The company decides to come to the market, the price you can get for 5% of your company is not the same price you can get for printing 1.75 trillion.
Right.
Those are two very different things. There's a lot of things moving
Yeah.
under the surface.
Yeah.
So yes, very small, de minimis. And then there would be also increased costs, both through risk in terms of tracking error and creating custom benchmarks for performance if one implemented that.
Okay. Just gonna ask a simple question. These indexes, they're no longer the old John Bogle indexes back in the 70s and 80s. Are you seeing any evidence of just more systemic risks in these passive strategies now because of rule changes, relaxation, should we be thinking about any inherent broader systemic risk embedded in these going forward?
I think on the changing rules inclusion, it's not. So I believe the FTSE 100, which is the UK large cap index, that has always had a fast inclusion process methodology, and therefore it is implemented in some of the FTSE Russell indices and not all. And so you could argue that it is a broadening. As for emerging risks, people do question whether the increased reliance on passive has led to a difference in price discovery in markets, i.e. there's a passive flow as 401k money hits the market on a sort of every couple of weeks.
Yeah.
That's, I think, separate maybe from whether, Russell is a large institution. They will have done a lot of homework on this. I do know they did a consultation with large investors on the back of these changes.
I mean, the intention of what Russell's trying to replicate is the market.
Yeah.
And what's available to buy for an investor in the market. And so it's float weighted, as Eugene mentioned, right? It's not market cap weighted, because if it was, then SpaceX would be a much bigger position. It's the float, what's available to buy, and based on the size of what's available to buy. So it's intended to try to replicate the market. That's the way Russell creates their index. S&P has a committee process that is, much more, I would say, subjective in terms of how it's designing what the market is, versus I would say Russell's is a little more of a rules-based methodology. The systemic, the risks are that it's hard to get like a good number on this, but I've seen some studies that indicate that more of half of the ownership of roughly half or somewhere in that range of the ownership of the U.S. equity market is passive index investing in some way, shape, or form. So there's been a big movement to move money away from active management to passive management. The risk at the moment, frankly, is that it's an incredibly concentrated index.
Right.
The top 10 holdings are the highest they've ever been. It's concentrated by industry, by sector. And so if you think you're owning this diversified market portfolio, you're not. That's the risk. And so, yeah, it's cheap, but be careful what you wish for.
Exactly.
Should we be considering something different?
Well,
That's on
you
the
always,
base
you,
side.
you always can, right? And there's always, that's a bigger discussion, I think, active versus passive or alternative forms of index management. Those are always things to be constantly asking yourself and thinking about. I think the thing I would always caution the board about is education on that, understanding that is crucial and an important part of your role, but shouldn't be driven by market timing.
Well, but this is what you're talking about is a systemic problem that other people have identified and a little different than the timing problem.
Yeah, but it's the reason it's becoming a topic is because of the timing of
So I think we should all understand all of these nuances here, and I love the discussion and thinking about the alternatives. However, we're doing really well here, as I think is the next topic on the agenda here. So let's just keep that in mind with the way we've done it up to where we are up to now here. So
On that note, let's talk about the summary report. This is of March 31st.
Yep, I'll keep this quick. So if you just turn to our summary report, so
I'll share screen too.
oh, okay.
Going.
So just quick, page 13, just your assets as of March 31st are about 3.7 billion. So getting close to the 4 billion mark. The next page, 14. So for the last quarter, the total fund returns were modestly negative. It was a volatile quarter, obviously, with the start of the Iran conflict that created a lot of uncertainty and down markets. And once that started on February 28th, since then markets have rebounded very strongly. April was an incredibly strong month. May was good as well. In June, there has been some volatility, but markets have rebounded lately with the peace deal or negotiated so far. So we'll look at your projected fiscal year return, but on the next page 15, your fiscal year to date return, and this is just through the end of March, on a net basis was just shy of 6%. Through the end of May, it's closer to about 15%. So, unless we have the world falls apart in the next how many more days and 2.5 weeks until the end of June, then you should be looking at a pretty strong fiscal year return. I'll just touch on a couple things. On page 23, looking at your domestic equity composite. So again, here we have your passive Russell 1000 exposure with SSGA. And then you have your small cap exposure with DFA. And small cap, this has been, it's been a bit a tailwind to your overall performance over the last year. You can see small cap has outperformed large cap. DFA was up 19.7% for the 1 year versus SSGA up almost 18%. And while DFA has trailed the benchmark, and that's primarily due to just low quality small cap names rallying, momentum based names, names that don't have any earnings or are highly levered have been outperforming. And DFA screens out low profitability names. So while they've trailed the benchmark over the last year, it has been additive to your overall domestic equity composite. Just turning to international equity on 25 quickly. So you have your passive exposure with SSGA, the World ex-US Index Fund, and then Trustee Vasquez brought up Times Square. So Times Square is your international small cap manager. They have been on watch. They do have more of a growth tilt to their process, and it's been value names in non-US markets that have outperformed. Because they, non-US markets typically just don't have as many growth-oriented names as the US. They're more focused on healthcare, financials, some of the materials and commodities-oriented areas. So that has been a headwind to their performance. Just kind of that growth bias has been a bit of a headwind to their performance. But you can see with Fidelity, the emerging markets portfolio there at the bottom, great boost to the overall performance, up 41% for the last year. So emerging markets has been a really additive component to your international equity recently. Just and then quickly, fixed income, it's pretty flat over the last quarter. Over the last year, Wellington was up almost 4.7%. You haven't had Dodge and Cox quite a year. They came in on May 1st of last year, so getting close there, but overall their performance has been strong as well. No other major, we could just skip to the very end at the flash report, unless there's any questions on the other items, but nothing of, any major concern. Again, just zoom in. It's small. My eyes get bad or both. So domestic equity on fiscal year to date basis up almost 23%. Your international equity fiscal year to date, again, this is through May, up about 27.5%. Fixed income up 4%. And then private markets, this is all preliminary and lagged. So, I wouldn't put much basis on here, but considering the public markets exposure on the prior page is the majority of your portfolio, you're in pretty good shape. So again, about a 15% preliminary net fiscal year return through May. Any questions?
For questions for this last item? Okay, thank you very much.
Need it.
Meeting adjourned.